Welcome to the European market open a minute to go until the start of cash equity trading. I'm Tom McKenzie in London, and here are your top stories. Fresh 40-year high US inflation is set to rise the most since 1981. The IMF slashes its growth forecast. So close. Euro traders get out their microscopes as the currency staves off parity with the dollar by 0.003 of a cent. Plus, Twitter hits back. The social network sues to force Musk to honor his $44 billion buyout. Okay, let's take a look at the futures then. After some modest gains across European equities yesterday, losses of almost 1% though across US stocks. You'd had that IMF downgrading just after a month after its most recent forecast to 2.3%. That's its outlook now for US growth. The data coming through then in terms of trade from China, slightly better than the surveys had expected. And then the May UK print in terms of GDP also beating the estimates. In terms of the futures, you're looking at losses then of 0.5%. The key data point today, of course, is the inflation print, the CPI print out of the US, where, of course, the surveys are looking at 8.8%. Will it be a peak? What will it do, if anything, to the Fed's thinking? Of course, the market's pricing in 75 basis points in terms of the next hike from the Federal Reserve later this month. Losses across the Spanish index, IBEX, down 0.5%. The CAC 40 also lower by 30 points. The FTSE 100 off by 0.4%. The BOE's Andrew Bailey just reiterating yesterday, no ifs, no buts. He says the 2% target is what we need to get back down to. Okay, so putting in place the expectation that maybe you get a higher rate hike. Certainly the market's pricing in 50 basis points now from the Bank of England when August 4th comes around. Let's move it on, see how things are playing out across assets. It's worth also highlighting that there is a bit of political risk as well bubbling through in Italy. Mario Draghi warning that he could step down if the five-star movement, part of his coalition, pulls out. There's a coalition vote later today in Italy, so watch that as well if you had exposure to the Italian markets. The future stateside looking currently at gains of 0.3%. The US 10-year, 297. There is that yield inversion between the 2s and the 10s, below the 3% level, of course, on the US 10-year, that benchmark. Not a lot of movement in the session today. Euro dollar, we talked about how close we got to parity, just within a hair's breadth yesterday. 1.0046 on the single currency, currently gaining 0.1%. And Brent, just above $100 a barrel, you're up 1.4%. The stronger export data out of China is in focus as well, but of course we dropped below $100 yesterday. Concerns more prominently that demand picture maybe is starting to erode for commodities. Let's get over to Bloomberg MLive Managing Editor Mark Cardmore. Mark, you are looking, of course, at the centrality of US inflation today.
Yeah, very much so, Tom. That's what everyone's looking at today. The US CPI print. Now, I'm a little bit confused about how the market reaction is going to go in this. You know, it's rare for me to not have a view, not have some conviction, but I'm really quite torn on this one because I think that yields and the dollar are skewed up in opposite directions. One point I want to make, or maybe 2 points I want to make, this is projections around consensus forecast for US CPI in 2022, full year inflation, and 2023. Now, first of all, we're now stand at 7.6% for full year CPI in the US. That was 9 months ago today. That was back at 3%. So that's really quite a drastic change. I think that makes the point about how much this inflation situation caught economists kind of behind the curve in this and really kind of failing to realize that, it wasn't going to be transitory, the whole inflation cycle, which makes me say that you shouldn't probably read too much into what happens after today's print either. This is still a situation which much of the world is struggling to cope with because of the base effects coming out of the pandemic, because of the extraordinary fiscal policy and monetary policy we've seen, and because of those rapid change in financial conditions. The other point I want to make is the forecast for next year is 3.4%. So economists at the moment, according to consensus forecasts, and as you know, I don't put loads of weight in them, but according to consensus forecast, we're going to go from 7.6% inflation in 2022 to 3.4% next year. That only really happens if we have quite an extreme growth slowdown or extreme recession, probably because we have much higher rates. Yes, base effects can play a part, but we're only going to see commodities collapse that much if we have a recession. So essentially, if this is going to come to pass, we've got a very deep recession coming, or perhaps these forecasts are completely wrong and need to be revised a lot higher.
Shock horror, wouldn't be the first time, would it, Mark Cudmore? Mark Cudmore, of course, MLive managing editor, with the context around that inflation print we're expecting out later today out of the US, of course, and the forecasts looking ahead into 2023. Quite the divergence, as he pointed out. Now, two big things the markets are watching out for this morning. Of course, central to that will be the US CPI reading as the IMF cuts its growth projections for the US economy this year and next. And euro-dollar parity still in focus for us today. That's after the single currency slid to within a whisker of a pure one-for-one rate. Let's get into the key market drivers then with Bloomberg's managing editor for EMEA markets, Lynn Thomason, and Giulio Renzi-Ricci, head of asset allocation for Europe at Vanguard, both joining me in the studio, which is fantastic. Lynn, let's start with what we're seeing in terms of looking ahead to that inflation print then, and whether there is a number that would fundamentally change the thinking of the Fed, and indeed whether we're getting to the point where inflation is starting to peak in the US.
Yeah, absolutely. I mean, we're certainly expecting that inflation number to come in very hot. And I think, for markets, as long as inflation is continuing to get hotter and hotter, the bull case for markets, I think, is very difficult to look at right now.
8.8% is the survey. Markets pricing in 75 basis points. If we come through with 8.8%, does that at least give some assurance, 8.8%, maybe a couple of bips above, give some assurance to the markets and now the trajectory is pretty clear from the Fed?
Yeah, I think absolutely that would reaffirm that things are on track. I think the real danger is that continually you've seen inflation come in a lot hotter than expected. And if that's the case, it would really be a danger zone because, report after report after report shows that it's, regulators don't have a handle on the situation.
Julia, let's bring you in at this point then, and your views on what you're looking for inflation. Is there anything that would change your views? And we'll unpack your calls on European equities shortly, but let's start with the inflation print then, and whether or not you see it peaking later today stateside.
So in terms of inflation, I mean, the things are a bit different, of course, depending on which side of the Atlantic you're looking at. But if we start from the US, what we're really seeing is, to some extent, one of the key drivers is the labor force going back to labor, to be employed. There is a high level of employment in the US right now, but there is still all the consequence of what we call the Great Resignation or the Great Retirement that has not really fully panned out into the economy yet. So one of the key drivers that we're going to see is if that labor force goes back into employment, that would help a lot, for instance, the Fed to reduce the inflation numbers for this year and especially next year. For this year, things are really murky, but the expectations for next year is that inflation will come down. Of course, the timing is very important, associated with what the numbers on economic growth would look like, right? So it's a question of what comes first.
And we're not seeing that participation rate. We saw that actually drop in the latest jobs numbers. And you have, of course, an unemployment rate of 3.6%. And Jay Powell has stressed that this is a very, very tight labor market.
That's right.
So that is a concern for you in terms of these inflationary dynamics going forward.
It is at the moment, in the sense that, as you said, the labor market is quite tight. So something, to some extent, almost culture, I would say, would need to change. And it's still a little bit unclear what the effect of all the fiscal policies that have been implemented last year will be and how long those will last in the US, because a lot of that in terms of employment was a function of the fiscal policy, the large fiscal policy that we have been seeing in the US.
And Lynn, of course, the inflation picture out of the US has an impact on euro dollar and the cross that we were looking at yesterday. We continue to keep a firm eye on it. Didn't quite get to parity, but of course, if you get a more hawkish Fed, pressure then on the euro, is the ECB going to be forced to step up at this point with the single currency this week?
Yeah, I mean, that's clearly the question, I think, for currency traders right now. I mean, the story has been that the ECB has been slower than the Fed, and that's been pressuring the euro. But how much weaker can they stand for this is really, I think, what the market is wrestling with right now.
I mean, Nomura's saying 90 cents on the US dollar for euro, particularly if gas doesn't come back from Russia, and that remains an open question. We were talking to the European Commissioner for Energy yesterday. She said things are just going to get worse when it comes to the energy front.
Yeah, I mean, it's just such a tough situation for the euro. I mean, literally almost everyone we talk to says the situation for the euro is going to continue to be on the downside. And, you know, it's all about the gas situation that, you know, as long as we've got this energy crisis in Europe, you know, assets like the euro are going to continue falling lower.
And yet, Julia, when it comes to the broader commodities picture, we've seen some weakness, whether it's on oil, whether it's on iron ore, on copper. The picture is slightly different today, but more broadly over the last few weeks, there's been that softness. Can we take any comfort from that maybe this inflationary impact of the energy price hikes that we've seen is starting to erode because demand is starting to weaken now?
That's absolutely right. I mean, for gas, it's slightly different. In the last few days and weeks, we have seen like a pickup again for the reasons that we were describing, mostly what is going to happen with Russia and how long we're going to be under-resourced from gas supply in Europe. So that is really one of the factors that increases the probability of recession for Europe over 2023. But to go back to your question about commodities, that's true. The market is basically in backwardation, and I think most of that is because of a fear of a recession for 2023. So the market is really pricing lower growth and lower demand.
What does that do to the energy trade then? One of the favored picks at the earlier part of this year, a number of strategists we get on saying you want to get exposure to energy, and they would have done very well on the back of that. Is that trade starting to crumble then?
To some extent, yes. One of the things that we've been saying in terms of commodity exposures, to some extent you would see a bit of that in energy stocks, is really as an inflation hedge. The thing is that you need to hold this type of exposures, commodities and energy stocks, ahead of an expected inflation. Now we're kind of a bit too late, behind the curve, so especially if there are increases fears of economic slowdown or recessions, probably commodities will not do as well as they have been doing over the past 6 months. And of course, the dollar, of course, a strong dollar doesn't help on
a strong dollar doesn't help. And currently, what are we looking at in terms of the dollar? Bloomberg dollar index, okay, it's off a little over half, just a couple of bips in terms of what we're looking at now. Euro dollar currently at 1.0039. The China factor when it comes to that demand for commodities, so much uncertainty around COVID-19, but the export numbers today coming out stronger than the surveys, and exports have been one of the bright spots for the Chinese economy last year. Of course, that pandemic demand. It seems like exports are coming in a little stronger. You still have a dampened consumer. What does the China play across European equities and across the commodity space?
Yeah, I mean, the other interesting thing I think you're seeing in China is, you know, the persistence of these zero COVID policies with, you know, the revival in COVID cases and continued lockdown, I think are sort of the counterpoint to the increase in exports that you're seeing. So, you know, anyone you talk to, the picture for Chinese markets is just volatility. I think it's just incredibly difficult to predict where things are going and what. You know, what's the regulatory landscape on some of these big tech giants as well?
It used to be the case that you would speak to people on the ground in China and say, follow the policy. Well, right. It's uncertain what that policy is. You have a vaccine mandate putting in place at one point, and now they've withdrawn that. And again, COVID zero concerns again today that Shanghai could face further lockdowns. Lynn Thompson, thank you very much indeed for walking us through some of the key themes for the markets. And there are quite a few meaty subjects, of course, for investors today, not least of them CPI. We continue to watch euro dollar as well. Giulio Renzi-Ricci, head of asset allocation for Europe at Vanguard, stays with us, and we'll get some of Giulio's calls after the break. Okay, coming up, China's exports, as I mentioned, strengthened in June as COVID outbreaks and lockdowns ease. But we do have those concerns around the COVID prints and numbers in Shanghai. More on the economic picture out of China after the break. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open on this Wednesday morning. We are 14 minutes into the European trading day. You're seeing losses across the broad benchmark here in Europe of about 0.5% future stateside, pointing to gains of between 0.2% and 0.4%. Of course, something of a holding pattern ahead of that all-important CPI inflation print out of the US later today. Let's check in on some of the stocks on the move at the Open. A number of corporate names to bring to your attention. UniCredit, we've highlighted this just because there is a little bit more Italian political risk emanating and bubbling up through the surface. Mario Draghi threatening to quit if the five-star movement, part of his coalition, walks away. There is a vote of confidence, essentially, later today. We're going to kind of unpack that story a little bit more for you, but maybe the banking sector a little exposed to that if, indeed, you do get that political risk coming back to the fore. UniCredit currently down around 2%. ITV, the UK broadcaster, of course, facing a probe from the Competition and Markets Authority here, currently gaining 0.2%. It's not the only one. Also BT, Sky, and others. ASML gaining 0.8%. This is linked to a story around Micron coming out and saying that it's had to reduce production out of one of its Japanese plants on the back of some energy problems around Micron, and so you could see a pickup in DRAM prices, which is why we've picked up ASML as well, just to see if anything is reflected across that. Currently gaining 0.8%. Let's get back to what's happening then in China and the data we got out just a few minutes ago around exports. Growth for exports beating market expectations in June. That's as COVID outbreaks and lockdowns eased. It did allow manufacturers to ramp up production while delivery times for goods were shortened. Joining me now is Enda Curran, Bloomberg's chief Asia economics correspondent. Enda, what was the key takeaway for you then from this trade data?
Exports were up 18%, Tom, in dollar terms, and that's a big takeaway. A very strong set of results for China's export sector. It speaks to what you've just said. Production came back online in the month. Logistics improved, as in factories were able to get their goods from the factories to the ports much easier. And of course, the ports themselves got up and running. So it all lent itself to China's manufacturing sector finding its feet. But even the ultimate end demand was stronger than anticipated. Now, the import side of it, though, was quite weak. That came in at around 1%. And that speaks to the idea that there's still plenty of softness in China's economy, that things aren't yet back to normal. And I think even looking at the strong trade data today, the strong export figures today, people are saying, well, wait a minute, there's an inflationary impact in some of that. So you've got your prices versus volume, and people aren't confident that this trade story will remain as robust as it is in the months ahead. But nonetheless, the numbers are what they are. It was a better than expected read for exports out of China.
Better than expected read, and of course we also had the credit data coming out of China coming in above 1 million expected, but also on the flip side, of course, continued concerns about the property market there. So Enda, as you look across the broader economy, what is your assessment of the health of China's economy, and as you take into account the latest trade data then?
Well, we do have a PBC briefing going on at the moment, actually, Tom, and some of the remarks coming out of that early on were the fact that there's plenty of liquidity in the financial system, for example, and it speaks to the idea that China's problem isn't the amount of liquidity going around or isn't the level of interest rates. It's more about the ongoing disruption linked to the aggressive COVID strategy of either lockdown or ongoing testing. That's impacting consumer sentiment. It's putting a brake on the recovery. And of course, like you said, the real estate story hasn't gone away. The big slump in activity there continues to be a drag on things. That pillar of trade, as we say, even though those figures that came out today look good for June, people are saying global demand is coming off the boil anyway. So later in the year, the export story for China won't look as good. So when you add it all up, that slow real estate sector, the ongoing COVID disruption, the expectation that trade will come off the boil over coming months, there's still plenty of work to be done to keep China's economy ticking over, and certainly a lot of work to be done to get it within even the ballpark of the government's growth target of 5.5% for this year.
Yeah, a murky picture then still for China's economy, and that growth target, as you say, Enda, 5.5% or about 5.5% sounds very ambitious at this point to many of an economist that we speak to. Enda Karan, Bloomberg's chief Asia economics correspondent, joining us out of Hong Kong with the latest trade data out of China. Julia Renzi-Ritchie, head of asset allocation for Europe at Vanguard, is still with us. Julia, everything we've been talking about today, we're looking ahead to inflation out of the US, the China exports data. Your call across equities, though, is maybe to get a little bit more exposure to European equities at this point. Given what we're looking at around the uncertainty of the gas pipeline, Russia to Europe, that is a bold call to make.
Yes, absolutely, I agree. It's really a question of considering a little bit on what the horizon that we're talking about is. So, of course, there is higher uncertainty and higher risk, and that's also for Europe compared to other regions, especially in the US, and that's also why for 2022, we are expecting a higher probability of recession in Europe rather than the US. However, that said, the idea is that the market correction has been much stronger on Europe and European equities, precisely because the market is basically pricing that risk, and so they're expecting a higher risk premium.
Are they pricing in the worst case scenario, though, a full cut-off of gas? And if they're not, where are they in the pricing of that?
Correct. So the idea is that the correction has been stronger there, and so now we're much closer to fair value levels compared to the US. So I think it's a good opportunity for buying at decent price for someone that is willing to accept higher volatility over the short term and looking at being rewarded more like over the next 3 to 5 years. So that's the call for being a bit more bullish on European equities compared to, for instance, US or rest of the world.
And alongside that is the call that bonds are now starting to play that diversifying role that they haven't for so many months. Where do you want to be in terms of duration along and around the bond space? Do you want to be near the short end? Is that where the opportunity lies? Or are you looking at duration at this point?
Well, that's a very good question in the sense that it really depends on what is going to happen in terms of inflation and economic growth, and which one to some extent will adjust in favor earlier. So the idea is that if there is a higher probability of recession or economic slowdown, having duration and treasury bonds in particular would be a good call for the reasons that we know. So basically going back to the typical negative or close to zero correlation between equities and bonds. So for that reason, we think it is still a good idea to take that safety exposure in treasuries, in bonds. And if you want a bit more risk, going into European equities, for instance, rather than credit at the moment.
Okay, so it really comes down to your assessment of how close we are to that recession in terms of how much exposure you want to get to bonds at this point. But the tilt towards European equities, that is the call then from Vanguard. Thank you, Giulio, as ever, for your insights and coming into the studio. Julia Renzi-Ritchie, head of asset allocation for Europe at Vanguard. Coming up, US President Joe Biden embarks on a 4-day tour of the Middle East. We will have the latest from Israel next. This is Bloomberg.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Welcome back to the Open. 24 minutes into the European trading day. European stocks off around 0.6%. The futures, the S&P E-minis pointing down by 0.1%, up by 0.1%, I should say. Nasdaq futures pointing to gains of 0.3%. Euro dollar off about 0.2% as things stand currently at 1.0012. Didn't quite get to parity yesterday, but got very close. Now to global geopolitics, and US President Joe Biden is set to embark on a 4-day tour of the Middle East. He'll arrive in Israel for talks with officials before setting off to Saudi Arabia, where he'll be seeking, of course, to salvage relations and hopefully get more oil. Bloomberg's Anne-Marie Horden reports from Jerusalem.
President Biden will be making his inaugural trip to the Middle East this week as President of the United States. And his first stop is right here in the holy city of Jerusalem. But don't expect any major breakthroughs when it comes to the United States and the Israeli government. It recently collapsed, and they are looking ahead to elections in November. So Biden and his administration will be in the hands of caretaker Prime Minister Yair Lapid. He'll also be meeting with opposition leader and former Prime Minister Benjamin Netanyahu. One key focus of this administration has been to normalize more Arab countries with Israel, and a key focus and a country to watch out for is Saudi Arabia. But there won't be any massive breakthroughs when it comes to dialogue or peace talks with the kingdom, but potentially more Saudi airspace being open to more Israeli flights. The president himself will be one of them, the first president of the United States to fly from Israel to Jeddah later in the week. He'll be meeting King Salman, the Crown Prince Mohammed bin Salman, and other Gulf country leaders. It's an interesting moment because the president is backtracking on a campaign promise to make the kingdom a pariah. But at home, he needs the Saudis' help to put more oil on the market to bring gasoline prices down. In Jerusalem, I'm Anne-Marie Horden, Bloomberg News.
And we will be getting plenty more coverage of that trip from Anne-Marie over the next few days. She mentioned oil, of course. Currently, Brent trading at $100 a barrel, just up 0.7%. WTI, $96 per barrel, up 0.6% as well. Coming up, UK politics and the economy remains in focus. We will dive deeper into the latest GDP figures and who's going to become the Conservative Party's new leader. That is all next. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Fresh 40-year high US inflation is set to rise the most since 1981. The IMF slashes its growth forecast. So close, Euro traders get out their microscopes as the currency staves off parity with the dollar by 0.003 of a cent. Plus, Twitter hits back. The social network sues to force Musk to honor his $44 billion buyout. Let's check in on these markets then. You saw losses of almost 1% yesterday across the US, across the S&P 500. Modest, very modest gains across European equities yesterday. Now you're looking at losses of around 0.7%. Investors, of course, holding out for that all-important CPI print out of the US, consequential not just for the Fed, but also euro-dollar, which we keep an eye on. As we mentioned in the headlines, the DAX down more than 1%. Auto is a big component here in terms of the drag on the German index. The FTSE 100 down by 0.9%, off by 62 points as well. We did have a GDP print that came out better than expected, and we'll unpack that story with Lizzie Burden shortly, and the BOE's Andrew Bailey as well, just recommitting to getting back to that 2% target for the Bank of England. Let's switch over and see how things are playing out then across these sectors. I mentioned autos as being the biggest drag across the DAX, and that is the sector posting the biggest losses, currently down 1.7% just in the first 30 minutes of the trading session today, followed by insurance and banks also under pressure. Two sectors in the green, as you can see, retail just getting 0.6%, and consumer products in a similar picture as well, up 0.5%. Let's get back to the macro then. The IMF cutting its growth projections for the US economy this year and next, warning that a broad-based surge in inflation poses systemic risks to both the country and the global economy. We are joined now by Michaela Markusson, Chief Economist at SocGen. Michaela, let's start then with the SocGen forecast when it comes to CPI stateside. The survey is for 8.8%. Is that in line with how you were expecting things to shape up?
So absolutely. But I think the key point that I'm watching here is not just the headline CPI numbers, but also what's going to be happening on the core numbers, because much as the headline continues to go up, we have actually seen a slowdown in US core CPI. And I think that's really what we're seeing right now in a lot of the data. We're at this crossroads where there are a number of signs of underlying slowdown in the US economy. You just mentioned that the IMF is revising down its outlook. My own outlook for next year is just 1.5%. And I think what we're seeing now is really that slowing factor. And that's some of the things that I will really be looking for this afternoon, to see that slowing of the core, something that we also see in the average earnings data. So that's really my key focus here.
And Michaela, when it comes to the response then from the Federal Reserve, the market's pricing in 75 basis points. Do you think they become more aggressive if we overshoot the print today? Is there a possibility for 1% from the Fed?
Well, I think 1% is going to be tough for the Fed to deliver. But what we clearly see, and we see this also in the ECB, there's clearly a trade-off here for the central banks. On the one hand, there's concern of doing too much and slowing the economy too abruptly. On the other hand, there's concern of not getting to grips with those underlying inflation. I mentioned the core number. The core number is still likely to print close to 6%, so it's still a very high number in US terms. And for now, the central banks are clearly preferring to err on the side of caution for inflation. So I think 75 basis points, as the markets are pricing in, is probably a very fair judgment at this time. What's interesting, though, is when we look further out, the market is well below the dots of the Fed, clearly giving us an indication that the market is worried that the U.S. economy will slow more abruptly than what the Fed is currently factoring in.
Okay, a sharper slowdown, possibly giving the Fed a pause for thought. When it comes to Europe and what we're seeing here, the challenge of the ECB, we're talking about euro-dollar parity, of course, the inflationary impact there. Does the Eurozone, does Europe can it avoid a recession at this point?
So I think there are a couple of things that are helping the euro area stay clear of recession right now. First, we're seeing a fair amount of fiscal measures coming through to support, in particular, low-income households, but in general also to support against the high energy prices. Second thing is that in terms of the savings rate, there's still some room there in the euro area. So I think there are a couple of buffers there coming in. And of course, there is less monetary policy tightening than what we're seeing in the US. As we look ahead, however, there are concerns for Europe, and in particular, of course, on the energy situation and what type of developments we're going to see here in the geopolitical situation over the coming months, and especially coming into the winter. So as we look ahead, my baseline is still that the euro area can avoid outright recession, but of course those geopolitical factors are a source of risk.
And you talk about this challenging balancing act for the central banks and just bringing it back. The challenge, of course, around addressing and being alert to the inflationary impacts of those gas flows or reduced gas flows, and then euro dollar. Does the ECB? There's a case. Goldman Sachs saying there's a case for the ECB to take a stronger line on the single currency to come out either and jawbone the single currency higher, or at least put in place a time frame or at least a policy response that would support the currency.
Well, I think we have to keep in mind that the ECB needs to manage several challenges at the moment. So one challenge is, of course, overall inflation. A second challenge, very important for the July meeting, is the question of the new anti-fragmentation tool. And then third is, of course, the question of the currency. But I actually think they somewhat come hand in hand. And my sense is that a powerful response in terms of the anti-fragmentation tool will also allow the ECB, and this is what President Lagarde tells us, is that we need to be able to ensure that we have that proper transmission of the monetary policy to also be able to fight inflation. So the anti-fragmentation tool becomes critical because that's also the tool that then allows the ECB to get tougher on inflation. But maybe just one point as well that I just want to throw in there just to consider in the relative balances between Europe and the US, and that's also the question of the size of the balance sheet. Keep in mind that while the Fed is engaging in quantitative tightening, this is not something that's begun on the European side yet. So here, looking a little bit further ahead, it will also be important to see what happens in terms of the TLTROs, and also importantly for the currency, what decisions the ECB makes on its current tiering on the remuneration of excess reserves. So quite a lot of moving parts there, but I think it's important to see how they all fit in together.
Yeah, certainly. And of course, there's been a bit of concern about the capital account as well of Europe amid some of these pressures. As we switch focus, Michaela, to the UK, and the number backward looking, of course, the data for May and the GDP print of 0.5% above the estimates. Do you have a sense that maybe there's a little bit more resilience to the UK economy than some had expected, given the strength of the labour market here and that slightly better print from GDP?
So I would love to be more positive on the UK and say that something exceptional is happening there. Unfortunately, I think the UK economy faces exactly the same headwinds as we see elsewhere, from the high inflation eroding purchasing power, from the geopolitical uncertainty, and then of course the UK currently faces its own political questions. And longer term, that issue of Brexit is not going away. So I think the question of how the UK economy becomes competitive in a post-Brexit world is a question that really hasn't been resolved yet. So unfortunately, when I look at the UK economy longer term, I remain relatively downbeat at this point in time.
Okay, still relatively downbeat on the UK economy. Mikaela Markusson, Chief Economist at SocGen, thank you for your analysis this morning, of course, as we look ahead to the CPI print out of the US. Let's get back to the UK and unpack that data then. The UK economy growing more than expected, as we mentioned, in May after 2 months of declines. A strong rebound in health services offsetting a drop in hospitality and consumer-facing services. Gross domestic product rose 0.5% after a 0.2% decline in April. Economists had expected growth of 0.1%. The Bank of England's governor says it will act, the BOE, on rates if necessary.
There are more options on the table than just another 25 basis points. And those options can go both ways. We've had no growth, effectively, in private sector GDP. We've had very little growth, overall. And so I reject the notion that we've somehow stoked up domestic demand. What we have had, however, so you may say, well, yeah, that's all very nice, but how do you get the inflation? What we have had is a series of very big supply shocks.
Okay, we are joined by Bloomberg's Lizzie Burden then to walk through the data and, of course, the analysis, or at least the take from the BOE as well. The UK politics also a factor as we look ahead to that leadership context. Lizzie, what is your take then on the GDP print that we saw, coming in better than expected?
Better than expected, but also it's a return to growth because, of course, the UK economy has been stagnating since January. So what's driven it? Well, health output, because you've had people going back to the doctor even as the COVID test and trace programme has been winding down and the vaccine rollout has been winding down. And you had a busier month for the road hauliers and for travel agents. So Rishi Sunak, one of the leadership contenders to be the next head of the Tory party, he'll likely pat himself on the back for this and say it's a sign that the fiscal support he provided as Chancellor is working. It's interesting that his successor as Chancellor, Nadhim Zahawi, has responded to these figures by saying we shouldn't be complacent. But as you hinted at, it might also embolden the Bank of England, because you heard Andrew Bailey there saying that the Bank of England's determined to return inflation back to target, no ifs, no buts. Well, that had led some people to say maybe the bank would even risk a recession to get inflation back to target. This data shows that the UK economy is holding up better than we thought.
And the market's now pricing in 50 basis points come August the 4th from the BOE. When it comes to that leadership contest then, where do things stand? They've whittled down the numbers.
Whittled, a word that we've heard a lot about. Well, Rishi Sunak remains the front runner, and there are now 8 contenders because we've lost the Transport Secretary Grant Shapps, the former Health Secretary Sajid Javid. He could have taken a bit of credit for these GDP figures today, given everyone's going back to the doctor. And Raymond Shishti has dropped out. You might never have even heard of him. But the next stage is the first round of voting today. The candidates need to get more than 30 votes and not come last if they want to proceed to the second round, which will be on Thursday. And then over the weekend, we'll have the TV debates. So it'll be whittled down, as you say, to 2 names by July 21st. And then they should have a new leader after the grassroots votes by September the 5th. But for now, Tom, the focus remains on tax. And the Resolution Foundation think tank has come out overnight criticising what it says is the government's denial, really, about the state of economic decline in Britain, which your previous guest, the SocGen chief economist, was hinting at. And Labour, the main opposition party, is criticising the economic competence of the candidates, because, of course, it's really only Rishi Sunak who's saying that we should wait for inflation to be under control before launching into tax cuts.
He's the outlier at this point, isn't it? Okay, I won't overuse the word whittle. I'm being gently mocked by Lizzie Burden for rolling that one out as we continue to watch the leadership contest heating up. Thank you very much indeed for breaking down the GDP data and, of course, the latest when it comes to that contest to take over as UK Prime Minister. Coming up, London Heathrow imposes a cap on daily passenger traffic as it struggles with surging demand for travel. We unpack that story for you. That is next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Welcome back to the Open. 45 minutes into the European trading day. European stocks lower by 0.6%. S&P futures are range bound. Nasdaq futures up by 0.1%. The sectors most under pressure here in Europe at the moment: autos, insurance, and banks. Just three sectors in the green: retail, price, consumer products, and real estate, all up by between 0.2% and 0.4%. Let's get back to the travel story, though. London Heathrow imposing a 2-month cap on daily passenger traffic to contain flight chaos. It is a dramatic response by the UK's busiest airport to address the struggle with surging demand for travel. Bloomberg's Sid Phillip covers European airlines, and he joins me now. Sid, what are the details then on this passenger cap? It crossed yesterday. For many of us, this was pretty remarkable, but you're saying this is a trend now that we're seeing.
Yes, it is. So essentially the airports, including Gatwick Airport, which is the smaller of London's sort of main airports, and also Amsterdam Schiphol Airport, they imposed caps on passenger numbers and flights last month. So Heathrow's just sort of following on. I mean, we've already seen the biggest carrier at Heathrow, British Airways, paring some of their flights this summer. I mean, they announced 10,300 cuts last week, and that was on top of cuts they'd already announced. So they've cut about 13% of their schedule flights this summer. And so we're already seeing a sort of wide sort of issue across the travel industry where airlines and airports are cutting capacity because they aren't quite sure they have the staffing to actually operate those flights, and they're sort of trying to prevent last-minute cancellations.
Okay, so this may well not be the last in terms of the moves that we're seeing across airlines and across the airports as well. Sid Phillips, thank you for walking us through what we saw yesterday, that announcement from Heathrow trying to address the challenges. Let's stay on the travel story now, because joining me for more is Martin Chalk, General Secretary of BALPA, the British Airline Pilots Association. Martin, thank you for joining us this morning. What is your assessment? What is the current state in terms of the ability for pilots to get back to work and the need for airlines to address the concerns of pilots at this point?
The industry is clearly still suffering from the ramp up. We were quite clear with the government back in September when they cancelled the furlough scheme that this would happen. We also approached them with a plan to address just the issue of restarting an industry that had been fairly much shut down for a couple of years because we anticipated this might happen. Unfortunately, that fell on deaf ears. Throughout the pandemic as well, the airlines themselves have continued a trend which they've had running for some time that has put a lot of pressure on terms and conditions right across the airport. This latest round of cuts, which I have to say are not so dramatic. 4% is still relatively minor. The vast majority of people will will therefore get away unhindered this summer, which is much better news than we've had during the spring. But nonetheless, this last round is still a symptom of the same problem, that employers are going to have to offer attractive returns and some level of security, given the lack of security that people have suffered the last couple of years, in order to attract good staff back into the sector.
And Martin, what is the gap now between the need that these airlines have for pilots and the workforce? What is the gap in terms of matching that?
So there's an immediate problem, and then there's a longer term problem. The immediate problem is generally not a supply problem. It is the challenge of training people that have had their currencies and licenses lapse due to a lack of work over the last couple of years. And that just takes time. And largely, it's not been pilots that have been the challenge this spring in terms of the cancellations. It's been all of our other colleagues who have been treated perhaps even more poorly than pilots have. It's not a supply at this stage of pilots, but it might well be in the longer term, because there are plenty of pilots like myself who will not return to flying. I'm only in my mid-50s, but given the opportunity to leave this sector and find other challenges, that's what I've done. I'm sure there are many of my colleagues who have done similar at the sort of senior end of the pilot world. And at the junior end, you're talking about pilots that have potentially paid a significant amount of money through their own or their family's resources in order to obtain a license, and who must work at a level of remuneration that allows them to service what is potentially a six-figure debt. And that means that some of the jobs that are being offered at very low wages are just not going to attract those pilots back into the profession.
Okay, some detail then on the need to attract and then retain the talent and the staff, the pilots, of course, to keep these airlines running. As you look ahead, Martin, possibly into next year, is there a concern that if demand starts to ebb from travellers, that you could end up in a situation where the airlines then have to cut back again? Is that a concern, or are we a long way from that?
I think there is a concern that exiting this pandemic, the rewards, if you like, that have been generated by some parts of the economy, and the IPPR suggested that from 3 years before the pandemic to today, profits are up 32% in non-financial industries. But since 2008, the workforce in general has seen a 20% real terms decline in their return. But with those sorts of figures in mind, you can see that the profits are not going, the benefits are not going to the workforce. And so the bigger challenge we have ahead of us is recession. It's not inflation, and neither is it supply side demand, supply issues. Those will be solved in relatively short time. It's the fact that the economy is sucking the wealth, the money into wealth and bonuses and into profits, and not recognizing that workforce need their part of that in order for the economy to function.
Okay, Martin Chalk, General Secretary of the British Airline Pilots Association. Thank you very much for joining us this morning, again, on the needs to address the concerns of pilots, to get them back into the workforce, but also looking ahead and looking out around recession concerns and the implications across the airline sector for employees as well. Coming up later on Bloomberg, we get the global market outlook with Steve Bryce from Standard Chartered. That's at 9:30 a.m. London time. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open. We are 55 minutes into the European trading day. You're seeing losses now across European equities of 0.8%. The selling most pronounced in Germany. The FTSE MIB as well, also lower by 1.2%. In terms of your sectors, losses on autos of more than 2%, followed by insurance and banks as well. Euro dollar took a leg lower at around 8.26 this morning. It is currently at 1.0026. Of course, the question of parity and whether or not the CPI print, it is inflation date out of the US. 8.8% is the survey. Is that data point going to be the number that knocks euro past that level? You had defense of parity yesterday. Does that crumble in the face of higher inflation, if indeed we get that? 8.8% is the survey. That is where investors are focused today. Euro dollar currently down just 0.1%, 1.002. We look ahead to the futures, of course, stateside. Range bound on the S&P E-minis after losses of 0.9% yesterday. Nasdaq futures gaining just 0.1%. That is it for the European market open. Surveillance early edition is up next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Bringing inflation back down to 2% sustainably is our job. There's no ifs and buts about that.
On Wednesday, we will have new CPI inflation data, and we expect the headline number, which includes gas and food, to be highly elevated.
I do think earnings numbers will still come down quite a bit, and whether we end up with a recession or not, I think there's a good chance that markets will price that probability as being higher than they have done as yet.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Fresh 40-year high, U.S. inflation is set to rise the most since 1981. The IMF slashes its growth forecast. So close, Euro traders get out of their microscopes as the currency staves off parity with the dollar by 0.003 of a cent. Plus, Twitter hits back. The social network sues to force Musk to honor its $44 billion buyout. Happy CPI day to you all. Markets certainly trading in a tight range as we look to see what CPI will bring. Will it be an elevated price that nears 9%? Tom Porcelli over at RBC says that's certainly a possibility, and we might be talking about a 100 basis point hike if so. IEA report coming out. Just want to bring you those lines saying that the oil prices threaten the economy as demand growth slows. We currently are looking at NYMEX crude under $100 a barrel. That fell below that level yesterday, trading ever so slightly higher, but it still is holding below $100 a barrel. It is the demand concern that is filtering through these markets, especially with oil. But it might be a little bit of bad news as good news. We're looking at U.S. futures trade higher this morning, but Europe is falling, maybe playing a little bit of catch up with the U.S. session yesterday, down 0.8%. Euro dollar, that is flat to slightly down. We didn't reach parity. We were very, very close. In fact, so close, some data sources showed us going through the floor, but Bloomberg data shows us still above parity at a 20-year low. Will CPI, a strong dollar that follows from it, be the thing that pushes the euro down? Villeroy over at the ECB saying that they are keeping a close watch on the weak euro. Finally, nat gas, another thing that has been weighing on the euro and the euro area, higher for a second day by almost 3%. Let me show you what the map looks like in Europe, because we are seeing most sectors down today. Most of them are sort of the industrial ones. Again, the fear of demand rationing, certainly see that in Heathrow with them asking some airlines not to sell summer tickets. Declines of mostly more than 1%. UK down more than 1%. DAX down more than 1%, as is Italy as well. So some risk aversion. But again, the big data point today is the CPI. That could change things for these markets. It's the data for June. It's expected this afternoon and expected to hit another fresh 40-year high. Now, that will likely see the Fed stick to its target of 75 basis points, or at least an aggressive hiking path. Taming inflation is the central bank's top priority, as Richmond Fed President Thomas Barkin emphasized when speaking in North Carolina.
We're engaged in a very challenging exercise, which is to try to cool the economy down to normal levels, right, in an effort to bring inflation under control, but without the intent of trying to cool it so down that the decline is calamitous. The right policy is to get inflation under control, period.
That was Thomas Barkin there speaking in North Carolina. We're joined now by Rebecca Chesworth, Senior Equity Strategist at State Street. Rebecca, thanks so much for joining. So I want to kick it off here. There feels to be this big differing of opinion when it comes to the direction of U.S. stocks when it comes to this earnings season. We have some banks saying, Citi, Bernstein saying, look, we've completely factored in weakening earnings. We also had Deutsche Bank recently saying that. Morgan Stanley, of course, the standout saying it will be an earnings shock. Where do you come down on this?
I think earnings are terribly important. So once we get beyond the CPI print, and I know that's been the news already this morning, that will be what drives the market from here. So we're in a market where people have gone short, and a lot of institutional investors have gone back to neutral. So I think there's some support to the market, but there on in, that next step down could be driven by earnings. And where we are is we have a disconnect. So we've got a lot of people, economists, strategists, anyone looking top down, who are saying these earnings come down. But then as you suggested, there's a lot of hype about what goes down bottom up, and I think the analysts are waiting to hear what the companies are actually going to say.
Well, we have started to see some cuts. I think it's something like 500 downgrades, net downgrades in the past week. That doesn't include just earnings, it's also price targets, those sorts of things. So are we starting to see that change in sentiment, or is it we're just going to wait and see and be optimistic until we do see?
So we're seeing the change in sentiment. So as you say, those net revisions are down, but they're still quite small so far. And really we're seeing then across the board, except for energy, really what people want to see is a little bit more precision. Is the consumer being hit more in some areas than others? Is the consumer being hit more by industrials, etc.? So I think it's definitely that news flow really starts on Thursday, tomorrow, with the banks, and there on in, it's going to be busy.
How are you feeling about the banks? I mean, pretty cheap valuations at this point.
Banks is a very interesting area. It's one we get asked about a lot. And sitting on that ETF side, we've seen huge outflows this year from banks and financial ETFs. I think this is at the time that maybe we start to see that change, because obviously rates are top of the agenda. But I tend to think that those European banks, which are much cheaper, which are going to face a positive rate for the first time in decades, that could be much more interesting than in the US.
I mean, we still see a yield curve that it's at its most negative since 2017 or thereabouts. I mean, can banks outperform in the U.S. if we are faced with that macro impact of a negative yield curve?
It's difficult. I must admit it's difficult for them. So there are two things that affect. One is the overall level of yields, and that is going up. But then that inversion does cause problems, which is why I would therefore prefer to look at Europe at the moment.
Yeah, we definitely have to circle back to CPI. Obviously, the number today. It is a strange environment where all of a sudden we're trading on these singular data releases. We're trading on University of Michigan sentiment. It feels like a crazy world, Rebecca. I mean, how much volatility are we going to see from now on out? Is this the new world?
I know, I'm surprised. You look at the VIX close last night, I think it was 26, average for the year. It feels higher. It feels higher. We know that clients are sitting on their hands because we know they want to wait to see what happens. And I think we'll just move, as you said, we move from University of Michigan, then we move to NFP, then we move to US CPI. Apart from the earnings, I think we'll then find another data point. I think it's going to be difficult all summer because, of course, liquidity always falls during the summer as well.
How bad is liquidity right now?
We're not seeing any actual impact on funds trading, which is very good news, but I think it remains a long-term factor. So some people who would have naturally bought on weakness every time will start to think about that, and it might start to constrain their behaviors in the future.
All right, Rebecca, stick around. I want to ask about some of the dip buying since you have such a good insight into the ETF world. So stay there. That's Rebecca Chesworth, Senior Equity Strategist at State Street. Coming up, UK politics and the economy in focus. We're going to dive deeper into the latest GDP figures and who will become the Conservatives' next party leader. All of that to come. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Risk sentiment continuing to deteriorate about an hour into the cash equity trading. European stocks down about 1%. Nearly every single sector is negative today except for real estate and retail. Auto parts, one of the worst. It's those higher beta sectors which seem to be taking it on the chin today. We are looking at energy prices going higher, so perhaps those fears of economic impact, maybe even more demand rationing to come. Now, within all that picture is the UK economy. It actually grew more than expected in May. That followed 2 months of declines. A strong rebound in health services. That offset a drop in hospitality and consumer-facing services. GDP at the same time rose 0.5%. That was after a 0.2% decline in April. Economists had expected worse. They'd expected growth of 0.1%. The Bank of England's governor says, among all of this, it will act on rates if necessary.
There are more options on the table than just another 25 basis points. And those options can go both ways. We've had no growth effectively in private sector GDP. We've had very little growth, overall. And so I reject the notion that we've somehow stoked up domestic demand. What we have had, however, so you may say, well, yeah, that's all very nice, but how do you get the inflation? What we have had is a series of very big supply shocks.
Of course, Andrew Bailey there speaking before we had the release of the GDP figures this morning. Let's dig into it. Joining us is Bloomberg's Lizzie Burden. So, Lizzie, a bit of an upside surprise for this.
Yeah, significant upside surprise, and more importantly, a return to growth for the UK economy. So, as you say, it's driven by health, people going back to the doctor, offsetting the wind down of the COVID vaccination programme and the test and trace programme. So this is likely to embolden Rishi Sunak in his race to be the next Tory leader and Prime Minister, because he can point to the fiscal support that he provided as Chancellor. It's funny that his successor, I should say, as Chancellor, Nadhim Zahawi, has commented on these figures and said we shouldn't be complacent. But it will also likely embolden the Bank of England, perhaps even to go for a half-point rate hike in August. Because you heard Andrew Bailey there. He said last night that the bank is willing to do, there's no ifs, no buts about getting inflation back to its 2% target. So some had already interpreted that as seeing the bank willing even to spark a recession to get inflation back under control. This data show that the economy is doing better than we had thought.
Yeah, so perhaps can handle that more than a 0.25% hike. You mentioned the UK Conservative leadership race. Rishi Sunak, perhaps this will support him. I find that really fascinating. So what does that mean, though, for where this race goes? What's next now that we have our candidates?
Well, Sunak's the front runner. There are 8 candidates on the starting line. Of course, Grant Shapps, the Transport Secretary, has dropped out, as has the Health Secretary, former Health Secretary Sajid Javid. He maybe should have stayed because these figures worked to his favour, but with all the doctors' action. And then Raymond Shishti has gone too, who you might never have even had on your radar. But the next stage is the first round of voting. So we'll have the result by 5 p.m. to get through know that the candidates need at least 30 backers and not to come last. Then you'll have the second round on Thursday, the TV debates over the weekend, and then it should be whittled down to 2 candidates by July 21st to be put to the grassroots membership to vote on, with a new leader in post by September the 5th. But for now, Danny, it's very much focused on tax. The Resolution Foundation think tank has come out overnight and criticised the government being essentially in denial about Britain's long-term economic decline, and Labour is attacking the candidates on their economic competence, because really it's only Rishi Sunak who's saying that let's not launch into tax cuts until inflation's under control. But with all this call for tax cuts, even that could embolden the Bank of England to go for bigger rate rises.
All right, Lizzie, thank you very much. That's our very own Lizzie Burden. And Rebecca Chesworth is still with us, Senior Equity Strategist at State Street. Rebecca, you've been constructive on UK stocks. Just looking at the numbers, down 3% year to date. That compares to down 15% for the stock 600, 20% for US. So with that outperformance, can the UK equity market hang on to it?
I think so. So we've heard from Lizzie this morning about those PMIs. That's the good news. Then you had before that the Andrew Bailey clip.
Sure.
That's the bad news, really. Rates carry on rising. But really, when we think about the UK market, this is quite a comment I always make, is the UK market is not the UK economy. We're a very global stock market with the FTSE. And what you see within the FTSE all-share and the makeup of it is the strength of energy. So we're overweight energy, we're overweight miners. They are areas which we still think will outperform before the end of the year. And then we've got a large defensive bias as well. So we've got those large healthcare companies, we've got those large consumer staples companies. All of that, I think, will help the market to perform relatively well against the rest of the world.
Well, we have seen some of these inflationary bets start to come off, at least when you look at things like break-evens. With that in mind, looking at oil falling on demand concerns, can energy stocks continue to be sort of the port in this storm that we've had this year?
Yeah, I mean, the energy story is changing the whole time, but I think we haven't resolved the global supply oil shock.
Right.
And, you know, if we just think what we've heard in the last 24 hours, we've had the IEA and we've had OPEC Plus saying, you know, the supply crunch has not gone away. So yes, that crude oil price did come back below $100 per barrel yesterday, and that is a key measure, and that means that forecast upgrades won't be as large as maybe we were thinking. But with inflation still a key issue, and given that we're going to be talking about the CPI this afternoon, then you need that inflation beneficiary in your portfolio still, because maybe that's the only thing that really holds its level, where everything else starts to struggle a bit more.
Well, perhaps to save us from what I'm sure is just going to be an all CPI, all things afternoon, I do want to ask you about tech, Rebecca. I was talking to you during the break that I was surprised to see that the ARK ETF had inflows year to date. Now, Bank of America once described this as the Pavlovian urge to buy the dip. When you're looking at ETFs, when you're looking at State Street's great selection of SPDR ETFs, do you still see people willing to buy the dip, especially that retail audience?
We do. So as I mentioned earlier, one worry is that people won't do that, but we do see that. And just in the last couple of days, we're seeing those tech flows come back and those consumer discretionary, because they're very, very important parts of the US economy. Now, personally, that wouldn't be a pick of mine for the next quarter, but I can really understand people wanting to put money in at this levels, especially if you have that long-term mindset and you can, you know, see it through another couple of what may be difficult months.
Yeah, I did hear some concern that perhaps that's not there, that pillar of support. Is it still a pillar of support of mom and pop type buyers in the ETF market for, again, the overall equity market?
In the US, yes. Okay. In the US, that retail investor makes up a huge percentage, but actually in Europe, we tend to be a lot more institutionally focused now. So there are different dynamics to watch there.
All right, Rebecca, thanks so much. Glad we got some of your ETF expertise in there as well. Rebecca Chesworth, Senior Equity Strategist at State Street. Let's get to some of our top stories with the Bloomberg First Word News. It's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Sri Lanka has imposed a state of emergency across the island and a curfew in the western province as police clash with demonstrators. A Bloomberg News photographer in Colombo says protesters are entering the Prime Minister's office. This comes after Sri Lanka's president fled the country earlier on a military jet. Now, the IMF has cut its growth projections for the US economy for this year and next after after just a month. It has also raised its unemployment estimates to 2025, warning that a broad-based surge in inflation poses systemic risks to both the country and the global economy. The IMF expects GDP to expand 2.3% this year, down from 2.9% it projected before. Now, Shanghai's COVID cases appear to be leveling off following a recent spike, though some residents have been urged to stockpile food and medicines as lockdown fears hang over the city. The financial hub reported 55 new infections for Tuesday, all found in people who have already been quarantined, a compulsory measure for cases and their close contacts over in China. The U.S. Bureau of Labor Statistics says a June inflation release circulating online is a forgery. Stocks slumped to session lows around the time the fake release started making the rounds on social media. The release attempted to mimic the formatting of the prior month's CPI report, but with different dates and numbers, including some errors. Global news 24 hours a day, on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thanks so much. Now, coming up on the program, Twitter's $44 billion legal drama carries on. We'll have the details for you next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Sri Lanka had imposed a state of emergency. That was after the president had fled. A new temporary acting president was put in place. Now, breaking lines, protesters have seized Sri Lanka's state broadcaster. This, of course, follows many protests, a lot of discontent in Sri Lanka over high energy prices, over inflation. Again, it's a general macro story of the concern there, but really acute in Sri Lanka. So again, protesters having seized Sri Lanka's state broadcaster. We'll keep you on top of those lines as they come. Let's take a pause on that and now move to Twitter. It's a blockbuster legal battle underway after Twitter filed suit against Elon Musk over his abandoned $44 billion takeover. Lawyers told a Delaware judge that the world's richest person changed his mind, trashed the company, and then walked away. Musk blames Twitter for not providing enough data on fake accounts. Joining us now is Bloomberg Quick Takes Alex Webb. Alex, okay, you've looked at the filing here from Twitter. What would you say are some of the main takeaways of their argument for why Elon Musk must carry this deal to the finish line?
They really are throwing the kitchen sink. There's a very rich document, loads of points they're making, but above all, the things that jumped out at me was they said that Elon sometimes didn't turn up for meetings. They said Elon admitted at a certain stage that he hadn't read the documents they'd sent him about how they calculated the bots and how many bots there are. And thirdly, maybe this is unsurprising, but they use his tweets in the filings. In fact, they even use tweets that have been published this week as evidence for why he's perhaps not being sincere, or why they think that it is not just that he's trying to walk away from the deal.
Feels so incredibly meta for a Twitter lawsuit filing to be using someone's tweets against them. What are Elon Musk's chances to win this, to be able to walk away?
It certainly looks quite slim. Now, I'm not going to make a call and say it's absolutely not going to happen, but if he walks away, I can't see it just being able to walk away scot-free. Whatever happens, he'll have to pay the $1 billion breakup fee, presumably, but I think it's highly unlikely that he wins. The case law, where this material adverse effect, material adverse charge, that's the thing he's leaning on, the notion that something changed in the understanding of the company, in the market, or the data wasn't complete. The Delaware Chancery Court has only ever allowed one deal to be walked away from in sort of 25 years. Kind of suggests that it's going to be very hard for him, particularly given the way that things have been phrased in his filing. It doesn't say, like, Twitter doesn't have the same number of bots that he says. It says Elon believes he doesn't, so it's like different phrasing.
Yeah, so very careful with the language, it seems there. Alex, thank you very much. That's Alex Webb from the Bloomberg Quick Take team. Now, coming up, walking a tightrope, central banks balance control inflation and avoiding a recession. Ahead of CPI, we're going to get Standard Chartered's tips on how investors can best navigate the uncertainty. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Fresh 40-year high, U.S. inflation is set to rise the most since 1981. The IMF slashes its growth forecast. So close, Euro traders get out their microscopes as the currency staves off parity with the dollar by 0.003 of a cent. Plus, Twitter hits back. The social network sues to force Elon Musk to honor his $44 billion buyout. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Francine Lacqua is out this week. Continuing, though, to look at equities which are selling off in the European session, around about the lows of the session, down 0.9%. Most sectors in the red this morning. We're again waiting for that CPI print. Tom Purcelli over at RBC says it could be 9% or just thereunder. And if it does, we could be talking about 100 basis point hikes. So perhaps not a big willingness to put on trades ahead of that figure, but we are seeing the commodity complex move higher. Brent crude, though, still below $100 a barrel. NYMEX crude, I should say, that was after the sell-off yesterday. Concerns about demand. Nat gas, that's moving higher, 5% higher so far this morning. Those are Dutch front-month futures. Nord Stream down, it's down for maintenance. Is this what Russia uses as an excuse to stop the flows? That certainly has been one factor beating up the euro. Still above parity, but not far from it. Now, central bankers, they're walking a fine line between controlling inflation and avoiding a recession. Standard Chartered sees inflation easing only gradually and the Fed maintaining its aggressive stance. The man behind that view, Chief Investment Strategist Steve Bryce, he believes raising allocations to bonds and tilting towards Asia and UK equities are the best way to navigate this tightrope. And he joins us now. Steve, thanks so much for being on the program with us. So I got to start here. Your note from the 24th of last month, bearish dollar, bullish euro. Are you still hanging on to that call?
Yes, I mean, this is a longer term view, right? So over the next 6 to 12 months, we sort of see the peak Fed coming in. So obviously that's difficult to see at the moment, particularly with the inflation print that's due tonight. But overall, we're saying that, you know, we will see inflation come down, base effects coming through, obviously some of the supply side pressures easing. And that will allow, ultimately, the Fed to start backing off from its aggressive rate hiking cycle. We're obviously not in July. We're still thinking we're going to see 75 basis points. But if you step back and say, has the Fed achieved its goal? And that sounds really strange. But if you look at long-term inflation expectations, they've already hammered those back to where they probably need them to be. So from the five-year down from 2.6 to around 2%. So that's obviously consistent with their long-term inflation goal. Now, inflation's been politicized. So, and within short-term inflation where it is, there's nothing they can do. They still have to hike. But if we do see that downtrend coming through in inflation in the coming months, then I think that will allow them to back off.
So is this sort of a natural coming down of inflation? I asked you, say, because there's this political element. Does that mean that the Fed talking about jumbo rate hikes, 75 basis points, that at this point is just this image game, this game of catch-up? It's not actually necessary to cool inflation?
I think they have to say that because they've been criticized so heavily for being behind the curve in inverted commas, right? So, you know, and if they weren't aggressive now, the risks for them politically are just so great, right? So they still have to be very aggressive. They have to talk very aggressive until it becomes very clear that inflation is coming off. So I think they have very little choice. I think that it does increase the risk to the global economy, of course, right? So we have a 40% probability of a recession in the US in the next 12 months, and that's the fly in the ointment. I think you would talk about it when you look at oil prices, etc. That is something that we just need to keep a very close eye on.
So your long-term view is one of this shift back to inflation starting to slowly come down, but we're about to get a CPI report that expectations are around 8.8%. How are you finding safety until we get to your base case scenario?
So, I mean, to be honest, we do have an overweight to gold, but that obviously gold broke lower last week, right?
Yeah.
So I mean, it worked really well for us at the beginning of the year, but obviously become a little bit more challenging in recent times. So the way we look at it, so we're pretty neutral across level 1 asset classes, so equities and bonds. We've increased our allocation to bonds, but on that growth slowdown view, so peaking rates, peaking yields. So we think that's an interesting opportunity for investors. Within equities, we're looking at places that actually are either protected from the economic cycle a little bit, or maybe even actually in a different part of the economic cycle. So we're overweight Asia ex-Japan equities because we believe that we're going to see China continue to stimulate the economy. As it comes out of lockdowns, then we're going to see the credit creation pick up, and that leads to stronger economic and earnings growth. So, so we're overweight Asia.
Are you willing to be bullish Europe at this moment, given the concerns around energy, around the pipeline, around Nord Stream?
I think it's difficult at the moment, obviously. It's often when sentiment is so poor, it's a great time actually to be bullish. So, you know, we're not sort of saying, no, now we need to get totally out or anything like that. But it is difficult to see how Europe is going to suddenly improve the situation. So, you know, you have to say with where the euro is, parity looks like it's going to be breached. I know we were incredibly close yesterday. We're still pretty close today, right?
Definitely.
So we could still see another leg down in the euro in the short term. But it is pretty difficult to be bullish in the short term.
Well, so you are bullish high yield. I wonder what you make of Marko Kolanovic saying that, look, equities, this is U.S. equities, they've mostly priced in a recession, perhaps too far, but high yield bonds, credit, they have yet to do that. So he recommended taking exposure off. Do you think that's wrong then? So
we're the reverse, right? Actually, so we'd agree on the equities piece, right? Okay. So if you look at the average pullback in equities during a U.S. recession, it's 27% since the 1950s. Obviously, the last two have been more severe, but then that was a global financial crisis and COVID, right? So they were deep, right, even short-lived in COVID's case, recessions, right, and financial challenges induced as well. So they were much sharper, but historically it's been 27% on average. If you get a shallow recession, we've seen peak to trough of 24% already, so that's pretty much priced in. So we'd agree on that side. However, we also think that high yields price in quite a lot of bad news already. If you look at the yield on high yield bonds today over the past 12.5 years, we're at the highs, right? So spreads have widened significantly. You're pricing in default rates of around 5%. And we don't think that in the recession, even if we do get that shallow recession, we're going to see that spike. So we think good value is actually there today.
Yeah, well, you're sounding a lot, I have to say, like Rick Reeder over at BlackRock, who does say, look, credit's safe. Default rates are going to be really low, but that brings me to this other conundrum of the current environment we live in. What's happening with the cycle we're in right now? Are we in completely uncharted waters that we're just skipping the default cycle while at the same time we're talking about 40% odds of a recession?
Well, I mean, you could argue that we're actually getting defaults through inflation, right? So the real value of debt is going down just because people will pay them in money that has been depreciated in real value, right? So you're actually seeing that through, and that should limit the default cycle as well, because then your earnings are going up, your cash flows are improving just because you're getting that inflation. So that should limit the down cycle, unless you're sort of saying, okay, interest rates are going to 5-7%, then that could be a very different environment. But that's, you know, in our view, we'll probably get up to 3.5% on the Fed funds, and then probably peak out. So from that perspective, yeah, credit looks good.
So I want to end here. You have your longer term themes, and one of them is this one of China, and tech has been extremely volatile in China around regulation, especially. Is this one of the long-term themes? Do you see that easing up and that being an attractive area?
So I think there's two things, right? So on the regulation side, we do believe that we've seen peak regulation already in China. So they are still very committal to their 5.5% growth forecast. That looks like a pipe dream, to be honest, today, given that the market is expecting around 4.3%. So we think we're going to be stronger than 4.3%, but 5.5 looks really challenging to hit. So I think the regulation, they really will back off on the regulatory side. They're also, you know, this China Common Prosperity theme of being self-sufficient. So you're seeing the geopolitical environment is very challenging. China acknowledges its reliance on the US and US technology. I think they want to break that down. So the technology sector is actually probably front and center of what they want to achieve. But that's technology, not necessarily communication services. That's very different.
Fair enough.
So.
All right, Steve, thanks for stopping by and visiting. Steve Bryce, Chief Investment Officer at Standard Chartered Bank. Coming up, U.S. President Joe Biden embarks on a 4-day tour of the Middle East. We're going to have the latest from Israel next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Equity is on the back foot this morning, but there is a lot of wait and see for what's expected to be another 40-year high in the CPI print later today. Tom Porcelli, RBC, says, look, it could be just under 9%. That could see the Fed go 100 basis points, or at least we might start to have the conversation about that. We were just talking to Steve Bryce over at Standard Chartered, who said that, look, inflation will start to come down. The Fed is aggressive for now because they're playing this game of catch-up. But on the long haul, it would be one where you want to go back into bonds. The yields, they might have peaked out. But throughout Europe, you can see negativity. FTSE 100, that's down 1%. A little bit better performing from the CAC 40. That's down 0.5%. The DAX also weak. Auto is one of the worst performing sectors. The higher beta sectors, the more cyclically associated ones, those are the ones that are performing the worst today. We're looking at energy prices in Europe. Those are moving higher, so that could have that impact of selling equities, at least in Europe. But again, will the CPI print turn that around? Will the CPI print be the thing that finally takes euro to parity? 1.0034. That's where we stand on the euro dollar. Let's get to some of our top stories now with your Bloomberg Business Flash is Leanne Gerrans. Good morning, Leanne.
Hi, Danny. Google plans to slow hiring for the rest of the year in the face of a potential recession. CEO Sundar Pichai emailed staff saying the company will focus hiring engineering and technical staff this year and next. He also called on employees to be more entrepreneurial and to work with more hunger. Now, Peloton shares jumped after it said it will stop building exercise bikes and treadmills at its own factories and rely on production partners instead. It's part of a shift to cut costs and streamline strategy at the fitness company. Peloton did boom during the pandemic, but has struggled as gyms and economies reopened. And finally, the Netflix hit Squid Game will compete for Best Drama at the Emmy Awards in September. It is the first time a foreign language program has been nominated for the biggest prize in the US TV industry. The show is the most popular in Netflix history and will be up against the likes of HBO's Succession and Euphoria. And that's your Bloomberg Business Flash. Squid Game 2 out soon, Danny.
I'm not sure that my heart can take another Squid Games. Great show, but maybe not sleep for a week. Leanne, thanks so much. All right, on to more serious matters. Joe Biden begins his first trip to the Middle East since becoming president. He'll first land in Israel. He'll meet with Israeli government officials as well as leaders in the West Bank. But the visit risks political embarrassment at home unless he's able to bring near-record gasoline prices down. Joining us from Tel Aviv, is Bloomberg's Daniel Avis. So, Daniel, obviously this is the first stop on a wider Middle East tour from Biden. What is Biden hoping to do to get out of this visit to Israel?
Yeah, absolutely. Thanks for having me on, Danny. So, as you mentioned, this is the first stop in Biden's inaugural visit to the Middle East. From here, he'll go on to Saudi Arabia for talks with King Salman and Crown Prince Mohammed bin Salman. But while he's here, he's spoken of a desire to integrate Israel further into the region, to sort of state that America is re-engaging with the region as well. But there's no getting away, as you say, from those tough economic numbers back home. Obviously, gas is still incredibly high at the petrol pump, and CPI very high as well, 40-year highs, and possibly even higher today. Those figures, interestingly, are due to arrive at around the same time as the US president here in Israel. And so we could well be in a situation where, as well as being greeted by the prime minister, by the president, he'll also be received by some quite unpleasant economic news, I think it's fair to say.
Well, tell me about the other side of this trip in Israel. What do the Israelis want out of this visit from Biden?
Absolutely. So, Israel has a new prime minister, Yair Lapid. He's been in place for just a few weeks now after the collapse of the former government. Israel's heading into its 5th elections in 4 years in November. So for him, he'll be very happy to burnish his credentials on the international stage. In terms of what the Israelis want from the Americans, there's talk of some sort of joint communique possibly being signed, which states very clearly the US and Israel opposition to Iran ever acquiring a nuclear weapon, and also guaranteeing Israel's freedom to operate in the region to protect its interests. There's also likely to be some sort of agreement on academic collaboration in the areas of artificial intelligence, quantum computing, things like that, and possibly also discussions around Israel joining the US visa waiver program, something that they've long wanted to do.
Daniel, tell me about what this visit could mean when it comes to Israeli bilateral relations with Saudi. What does that mean in terms of course, Biden trying to get more oil production out of Saudi, trying to repair those relationships? What will this do to that? Sure.
So as you say, after this visit, Biden's due to go to Jeddah. He's due to fly directly from Tel Aviv to Jeddah, the first time that such a trip will be made by a sitting US president. And so that visit really will deal with the question of oil. But in terms of that bilateral relationship, there is talk possibly of some gradual step in the direction of normalization between Israel and Saudi Arabia, a very different sort of pace to Israel's normalization with the United Arab Emirates, with Bahrain, with Morocco back in 2020 under President Trump. Things that are being discussed, possibly overflight rights over Saudi airspace. So for commercial airlines traveling to and from Tel Aviv, instead of having to go around Saudi Arabia, they'll be able to fly directly over the kingdom, which will mean places like Southeast Asia, East Asia, and possibly even Australia will become possible destinations for direct flights from Tel Aviv. So that's one possibility. There's another discussion around the possibility of integration, further integration of Israel into the security architecture of the region, which may well lead to some sort of joint communique that would mention Israel and Saudi Arabia in the same sentence. But as I say, gradual steps, and that's in large part because Saudi Arabia continues to publicly state that there can be no real normalization with Israel until there is some significant progress made on the issue of peace with the Palestinians, something that neither the Israelis nor the Palestinians are hopeful of ahead of the Biden visit later today.
Yeah, Daniel, why don't you just wrap it up for us? Is there anything else on this agenda that we should be watching out for on the trip?
In terms of the broader Middle East trip, obviously, as I say, Biden is here for a few days. While he's here, he'll meet with the Prime Minister, he'll meet with the President, he'll meet with opposition leader Benjamin Netanyahu, who would very much like to return to power after a year out. And he'll also meet with Palestinian Authority President Mahmoud Abbas. As I mentioned, unlikely to be any significant progress made on that issue, but there could be some announcements made around improving economic conditions for Palestinians living in the West Bank. And then, of course, he'll get back to the airport, get on that plane to Jeddah for that all-important meeting with the Saudi King and Crown Prince, and also a wider meeting of what's known as the GCC +3, so the GCC plus Iraq, Jordan, and Egypt. And that meeting is likely to deal with a range of regional security issues as well.
All right, Daniel, thank you very much. Bloomberg's Daniel Avis in Tel Aviv. Now, markets, we are looking at some bond buying happening. There is some bull flattening of the curve. We're looking at the most negative yield curve, the most inverted since 2007. That continues on. Elsewhere, there are some risk appetites diminishing throughout the equity market. In Europe, we're near the lows for the day, down about 0.6%. It was down about 1%, so not as bad. But again, it's a lot of wait and see ahead of that CPI report. A CPI report where if it's very strong, could see that bid come back into the dollar and the euro yet again get closer to parity. We missed it by just a whisker yesterday. Some data sources even showing us dropping through that floor of 1 to 1. But at the moment, we are at 1.0026 on the euro versus the dollar. There are concerns about the gas crisis in Europe. You can see energy prices moving higher for a second day. That's the last one there. That's Dutch front month futures. Europe natural gas futures up 6.2%. Nord Stream 2, that is down for maintenance. Is that what Russia uses as an excuse to cut off the gas flows? That could cause even higher inflation, economic woes, and thus that's how we get to euro parity. Sinking even further, Jordan Rochester says 90 cents could possibly be the floor. And there you go. That's 2s, 10s, what I was mentioning. Most negative since 2007. Is that the sign, the strong sign that we've been waiting for, that a recession is on its way, or perhaps it is already here? Now, coming up, London Heathrow imposes a cap on daily passenger traffic struggling with surging demand for travel. That story next. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
But on a macro scale for the UK, it's going to lead to a summer of discontent. It could lead to higher wages, more broadly speaking, and that makes life trickier for the central banks. They're looking at high inflation, looking at rising wages. They should be raising rates in that scenario. But they're also seeing economic crisis building up in the future, in their pipeline. We have, especially if the gas situation gets worse.
Jordan Rochester there from Nomura talking about flight cancellations from Heathrow, predicting a summer of discontent. Now, it's all that travel chaos contributing to it. London Heathrow is imposing a 2-month cap on daily passenger traffic to contain flight chaos. It's a dramatic response by the UK's busiest airport to address the struggle with surging demand for travel. Joining us now is Bloomberg's Leanne Gerrans to get into it. Leanne, so what do we know so far about this passenger cap?
So we know that Heathrow is saying 100,000 daily passengers, and that's it, no more. And what we know is, according to the latest forecast, they're saying it will be 104,000 people are going to be passing through the airport. And I spoke to Heathrow yesterday, and they said to me it's that 4,000 that is the sticking point, because obviously they have been suffering with staff shortages. And this is due to the pandemic, Danny. You know, so many staff were laid off during this time, and now rehiring has been a real issue. But Heathrow feel that this is the best way to make it safe for travellers to get through the airport. And we spoke to Manus yesterday. He was like, there's just baggage everywhere. So it's also to stop all of that frustration.
You know, it's interesting. Heathrow is obviously top of mind for us since it's close to you and I. We travel from it. Probably a lot of our viewers do as well internationally. But we were just talking about this during the break. I mean, it's not even Heathrow that's the worst when it comes to delays, is it?
Yeah, know, I was really surprised by this. So a new survey came out today from Hopper, and it was basically saying that Heathrow Airport, we are seeing all these delays, all this chaos there, but it's only ranked 15th as the worst airport in Europe for delays. Luton is actually ranked 4th, so it was worse. And actually the first ranked for delays and chaos is Brussels Airport. So Heathrow is actually ranked 15th, just to remember that. But I want to have a look forward to all of this, because we must remember one thing. It's all about staffing shortages, and what the airlines are trying to do now is, you know, escalate that and get more staff in. But because it's all about security checks and controls, it's not as easy as possible. And we talked about this being the revenge summer. So many people want to go after the pandemic. They want to travel abroad. But, you know, people and flights, there's just unfolding chaos, really. And what we need to remember is this will all sort itself out. But Heathrow are doing this at the moment, and they're saying there'll be another 2 months of discontent.
Yeah, and you can see that pressure in IAG share prices. You pointed this out to me earlier, down 3%. Certainly concerned that that demand rationing is going to hit the airlines. Leanne, thanks so much. That's our Leanne Gerrans with the latest on the travel story. Bloomberg Surveillance continues in the next hour. Matt Miller and Kaylee Lyons in New York, Anna Edwards out of London. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Market is very long dollars right now.
The U.S. equity market is part of that story. It's already signaling that things are going to get worse. The question is how much worse and how quickly.
We're going to see a lot of business models really challenged, and that's where you'll have something breaks.
I'm not sure that we will see disruption from this slowdown in the economy.
There's a lot of pent-up demand. Retailers are getting consumers used to the fact that inflation is building, and some of that and more of that will be passed on to them.
I think on the inflation front, I think we're winning the war.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
Good morning. It is 5 a.m. here in New York, 10 a.m. in London, and 5 p.m. in Hong Kong. Welcome to Bloomberg Surveillance, the Early Edition. I'm Matt Miller with Kaylee Lines in New York. Anna Edwards with us out of London. Our top stories today: inflation in the U.S. probably set a new 4-decade high last month. That will keep the Fed on track for another big rate hike. And it's all about the oil. President Biden is on his way to the Middle East, where he'll try to persuade Saudi Arabia to boost crude output. Plus, Twitter takes Elon Musk to court over his scrapped $44 billion buyout. Meanwhile, Google is putting the brakes on hiring. So there's a lot going on today, but we are really focused first and foremost, Kaylee, on inflation. What do you see in terms of the Asian markets in preparation?
Well, of course, they closed before we get that data in about 3.5 hours time, but all said, it was a modest update in Asia overall. The MSCI Asia Pacific Index higher by about 1/3%. Interestingly, a major outperformer was Taiwan. Stocks there up 2.7% after authorities pledged to support the domestic markets in a way they haven't done since the onset of the pandemic, really, in 2020. Of course, the Taiwan benchmark index was down 25% year to date before today, so now some intervention coming in to try and stem those losses. In other asset classes, foreign exchange in particular, your big outperformer in Asia today is the South Korean won, after the Bank of Korea delivered a jumbo hike, a record 50 basis point hike, following on the lead from other central banks. It also pledged to tighten policy further to fight inflation. So as a result, the South Korean won stronger against the dollar by about 0.4%. Final note in the commodities complex, I wanted to point to palm oil because futures were down another 5% overnight. They are now at their lowest level going back about a year. On the one hand, you have concerns about demand broadly in some of those crop spaces, and also potentially an inventory glut in Malaysia in particular. So that weighing on those futures overnight, Anna.
Yeah, and in fact, a lot of weakness in commodities to speak of overnight, Kaylee. Let's focus in on the European story, and European equity markets are weaker this morning, factoring in a bit of the later in the day net nervousness on Wall Street yesterday. And so European equity markets moved lower, cautious, waiting for that US CPI print. We got confirmation of some of the European relatively high inflation data. We got confirmation of that in the early part of today's session. I've got a couple of currencies that aren't really moving very much today, but certainly interesting stories to talk about. The parity party then on euro dollar, well, that had to wait. We didn't get there yesterday. We're a little away from it today, only a fraction away, of course. 1.0033. The 21st of July is now seen by investors as going to be a really important day. We get to hear from the ECB that day, but that is also the day that the flow of gas is supposed to be turned back on from Russia into Europe, and a lot of investors are saying that that latter point is actually going to dominate and perhaps be more important than the former. The pound, I also put this in because 118 is where we trade on cable. We got the GDP data out from the UK, and there are some difficulties with interpreting the data because of the movement of a public holiday, but essentially the data was better than had been anticipated. But will it be enough? There were some warning signs around the consumer in that data if you were looking for them, and that perhaps doesn't bode well for the future. And I also put in JD Wetherspoons, affectionately known as Spoons. Matt, you may have heard of it here in the UK. It is a pub chain, and yeah, I know he has. We've talked to the CEO a number of times. Anyway, a profit warning from them. It seems that the pent-up demand that they were expecting to see post-lockdowns for pubs in the UK has not quite materialised. Maybe all their potential customers are stuck at airports or just trying to keep cool somewhere. Maybe they should advertise their air conditioning.
Tim's a great guy, and I love the pub. No secret there. Anna, I'm looking at S&P futures that are higher today, and this is interesting to me because the last time we got an inflation print, remember that CPI that was 8.6% on June 10th, we lost a solid 200 points on the S&P index in the next two sessions. Actually, I think like 225. We were down 2% on that Friday. We were down 4% on the Monday following. So it was a show in terms of what happened to markets. 10-year yield right now holding just below 3%, 2.9576 as investors seek a little bit of safety in government debt. NYMEX crude is up a little bit, but still at 97.14. Had a big drop yesterday below $100, and it's holding down there. And then Bitcoin, right now at 19,818. Remember what happened last time we got an inflation print? We were hovering around 30,000 for so long that I wanted to take Bitcoin off the board. It dropped by $10,000, by a third in less than a week following that inflation print. So watch Bitcoin if we get a surprise to the upside today. Now, of course, it is the main event. It isn't until 8:30 a.m. New York time. So we still have about 3.5 hours until CPI comes out. For more on what to expect, we're joined by Kriti Gupta, Bloomberg Markets correspondent. KG, what do you got?
Hi. Well, let's talk about the estimates here because we are asking once again the big question, has inflation peaked? Is it in the rearview mirror? That peak was supposed to come in March, Matt. We haven't actually seen that happen yet. And remember, these estimates, right now, the CPI estimates, 8.8% year over year. The prior, remember, was 8.6%. If you put that and look at Wall Street, you actually start to see ranges for going 8.6%, the same as the prior, going all the way up to 8.9%. Even Bloomberg Economics saying that they could go as high. The big question here is this the highest? And there is, I think, a little bit of a consensus that we probably haven't seen the peak here.
Yeah, we thought we had seen it before, and that was proven wrong last month. And of course, the Fed is focused on that headline number, even though Wall Street may pay attention to that core metric month on month. The Fed says ultimately food and gas is what the American people feel, so we have to react to it. At the same time as we await this data, we also have a yield curve, at least for 2s 10s, the most inverted going back to 2007. Not a great signal.
Not a great signal, but it's across the curve. And you're seeing this in the 2s, 10s, 10s, 30s, which actually brings me to a terminal chart. For our radio audience, stick with me here. This is important. I'm bringing back an old favorite. David Ingles made this a Top Gun favorite, Top Gun reference for Matt Miller, for Kaylee, for our producers, of course, saying I was inverted. But basically, we're looking at the 5s, 10s curve here, which in the last, I want to say, year to date, really, has kind of bobbed in and out of inversion territory. And the reason I look at the 5s, 10s is the belly of the curve to kind of get this broader signal of really all those kind of maturities. And what you can see is this pricing in the market where you're not really sure if the Fed will actually hike into a recession, if the inflation ends up becoming the straw that breaks the camel's back, in addition to the decelerating growth that's already there. So that's going to be certainly a metric that we keep our eye on. We also are going to keep an eye on the currency strength here because the dollar is really what matters. As we see those higher inflation reports, the idea here is that the Fed is going to go tougher and tougher, even more hawkish. Do you start to see that actually break the back of some of these other currencies? We're already talking about euro-dollar parity. We're already talking about record Japanese weakness and even the cable rate. Some people out there saying maybe start talking about cable parity. A lot of that is going to be a function of the dollar and what you see in today's inflation report, as well as the Fed's reaction, Anna.
We'll be watching our own maverick on the markets. Kriti Gupta, thank you very much with the latest there. Now, the IMF has cut its growth projections for the US economy this year and for next. It's warning that a broad-based surge in inflation poses systemic risks to both the country and the global economy. For more, we're joined by Enda Curran, Bloomberg Chief Asia Economics Correspondent. Is this the IMF slow to the downgrade party, Enda, or is it the pace at which they're downgrading their forecasts that's of interest here?
Well, it's certainly a sharp adjustment. They've cut their forecast from only 1 month ago, Anna. They're now looking at growth in the US of 2.3% this year, down from 2.9%, and they're expecting unemployment to go up to around 3.7%. They also said that the authorities have to focus on getting inflation down, but they need to do so without causing a recession, which they say would be challenging. Now, they didn't give any particular reasons for the growth downgrade, but we do know, of course, that the consumer seems to be coming off the boil in the US, so perhaps the IMF is now trying to get ahead of the curve and signaling where these rate hikes will start to cause pain in a couple of months from now.
Okay, so that's the U.S. economy. Enda, let's talk about the Chinese economy as well, because we got trade data overnight, and whew, those exports.
Yeah, bumper exports, stronger than expected, up 18% in dollar terms. It reflects a number of things. It reflects the fact that the ports were able to reopen, the factories were able to reopen, as all of the restrictions around the Shanghai region lifted over the month of June. So it's clearly a strong number. A lot of economists saying, though, that demand won't hold up. Part of it is rebounded due to the reopening, and partly as we go into later in the year, they expect Western consumers to start feeling the strain of those interest rate hikes and buying less Chinese goods. So I don't think anyone expects this export story to hold up. The PBOC were out this afternoon as well, and they made the point that the economy still continues to need support. So I don't think anyone's calling a kind of a V-shaped turnaround or anything just based on these trade data.
And thanks so much, Bloomberg's Enda Curran there talking to us about economic outlooks and data points. Now, President Biden's problems at home are looming over a Middle East trip that's all about oil. The president arrives today in Israel, the first stop on his agenda. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now out of Jerusalem. And really, Anne-Marie, we're going to be focused on his ask to MBS later on in Saudi Arabia.
Yeah, he'll be in Jerusalem and the West Bank this week before he makes that trip over to Saudi Arabia. But Matt, you're right. That meeting with the Crown Prince, Mohammed bin Salman, and King Salman and the other Gulf leaders is really going to be the most significant part of the trip. And that's where everyone is watching to see, one, how the interaction is, because remember, this is a president who campaigned on making the kingdom a pariah. But also for the oil market, this is a big moment to see if the kingdom is willing to step in, maybe alongside the United Arab Emirates, to potentially help the president for his biggest problem at home, which is, of course, bringing gasoline prices down.
Anne-Marie, thanks very much. Bloomberg's Anne-Marie Horder joining us there from Jerusalem. She will, of course, bring us all the latest as that trip continues to other countries as well. Now, in Sri Lanka, a state of emergency has been declared after the president fled the country. Protesters gathered outside the presidential palace following the president's departure for the Maldives. Ruth Pollard of Bloomberg Opinion joins us now from New Delhi with the latest. Ruth, we understand that the state broadcaster has now been captured and scenes described as tense around the Prime Minister or acting president's residence.
Yes, I mean, it's a very fluid situation in Colombo right now. There are heavily armed security forces in riot gear trying to protect these government buildings, but we're just getting reports that protesters have stormed the Prime Minister's office now and taken control of that. We understand the national broadcaster is back on air, but we now have an acting president in Ranil Wickremesinghe, who the protesters are also calling to resign. They've been protesting peacefully for months along Colombo's waterfront, and they see Wickremesinghe as just part of the political elite that has brought the country to its knees and caused this economic crisis. And they say they won't stop until Wickremesinghe also goes. So for now, the IMF talks that were underway will inevitably be delayed until there is a government in place. And right now, all we can see for this island is economic instability and a deep political crisis.
Ruth, thanks very much. Yes, this ongoing political and economic crisis will continue to bring you the latest. Ruth Pollard of Bloomberg Opinion. Some of the pictures, you know, we see protesters on the streets now. Some of the pictures you were looking at there were protesters over the weekend queuing, forming a line to try and visit the president's palace, which, of course, has already been stormed by protesters. Now, a blockbuster legal battle is formally underway, if we get through to the tech story, after Twitter filed a suit against Elon Musk over his abandoned $44 billion takeover offer. Bloomberg's Alex Webb joins us now with the details. Details then, Alex, on this. I mean, this is as expected, I suppose, this legal action being taken.
Yes, we knew this was coming. It was a very poorly kept secret, but the nature of what's in the filing is, of course, fascinating. Some of the accusations they're levying towards Elon, the idea that he apparently said that he hadn't read some of the documents they sent him, which outlined the bot situation, that he skipped some meetings. These sort of details are, you know, grist the mill to the idea that he might struggle in a court case. Of course, we're yet to see what his response might be. The only filings we've had so far from his side are the fact that he believes there are more bots on the platform. They haven't sort of said explicitly there are more bots on the platform. So there is some very finely picked language from the Elon side and a deluge of things from the Twitter side.
Well, and another argument Musk has made is that Twitter has failed to operate its normal course of business because, as we know, the company instituted a hiring freeze after the news of his planned buyout, which, of course, now is a question mark. And on the subject of hiring, we also heard from Google overnight they're slowing hiring for the rest of the year. The CEO saying, hey, we're also not immune to economic headwinds.
The thing we know is in recessionary environments or in economic slowdowns, the first thing that companies tend to cut is their advertising and marketing budget. And of course, these companies are fundamentally advertising companies. And so we've seen also at Facebook, they've frozen hiring. Google perhaps is a little bit more robust than some of the others, but if even Google is struggling in this situation to carry on the same pace of hiring that it was before, it means that companies further down the food chain, like Facebook, like Twitter, are going to find things even trickier. So it doesn't all get terribly well for that advertising market.
Alex, thanks very much. Bloomberg Quick Takes, Alex Webb with the latest on some tech themes this morning. Coming up on the program, we will get back to thinking about that inflation print. Will it be a 41-year high for US inflation later? We'll talk to Sandra Horsfield, Investec senior economist. That coming up shortly. And Gary Shilling, president of A. Gary Shilling & Co. and author of The Age of Deleveraging. We will speak to him shortly. Plus, the cautionary tale of 3 arrows. How betting on rising prices blew up the hedge fund and set off a crypto contagion. Read more on today's Big Take story on Bloomberg.com or by typing NI Big Take into the terminal. This is Bloomberg.
City of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Season is here.
It's a low bar going into earnings season.
There are bargains out there to be had.
Bloomberg is fastest with the numbers and analysis.
There's conflicting and complex cross currents. Strap yourself in for this earnings season.
Bloomberg, the fastest numbers and analysis you trust.
Welcome back to Bloomberg Surveillance Early Edition. We are simulcast on radio and television. I'm Matt Miller in New York with Kaylee Lyons, Anna Edwards with us out of London. Now, we are focused on CPI today. Just 3 hours and 12 minutes until that number comes across the wire. And last time we got a CPI readout, it ended up in a cascade of risk assets. Ven Ram joins us right now, Bloomberg MLive currency and rate strategist, to talk about, I mean, really, this is behind everything, including parity in the euro to some extent, right? Ven, what do you expect today?
Absolutely, Matt. I do think that we may get a slightly higher than forecast inflation reading. And if that happens, I think that the front-end rates, front-end treasuries will sell off a lot more than back-end treasuries. I think the back-end treasuries are approaching the peak of the cycle. And what that means is a higher, faster CPI print will propel the dollar even higher towards 110 on the DXY. And that, as you mentioned, will feed into euro weakness, further euro weakness. And we have been flirting with parity level for the euro dollar for a couple of days now. That hasn't happened, but it may just happen after the CPI.
Yeah, I'm not falling for that 2 days in a row, Ven. We were watching it tick by tick yesterday, and it just didn't get there. We'll learn for next time. Let me ask you about U.S. stocks then. In that context, Ven, I know that you've been looking at how cheap or otherwise U.S. stocks are and whether they get any cheaper.
I think that they are pretty cheap, but they will get cheaper. If you look at the earnings yield on the S&P, we are now around 6%. So investors get about 3 percentage points higher than the 10-year Treasury yield. And that, if you look at the Fed model, the traditional Fed model, that would suggest that stocks are cheap. But I do think that based on my calculations, which are available on the terminal, I do think that stocks have further downside. Specifically, I think that the S&P has a downside of about 7% from current levels, and the NASDAQ 100 about 10% or slightly higher than that.
Okay, so Ven, if there's downside for stocks, how much more realistic upside room is there for the dollar as we talk about this broad-based dollar strength?
I think there's a lot. There is considerable upside for the dollar simply because you've got a scenario where the economy is going to slow because of the Fed's tightening. But at the same time, if inflation continues to be high like this, I mean, as you mentioned earlier in the program, we thought that the peak inflation was in March, but the June numbers negated that idea. And if we are going to get successively high inflationary prints, the Fed is going to keep going. And in that atmosphere, the dollar is going to get stronger simply because of real yield differentials are going to favor the dollar and propel it much higher from here.
Ben, thanks so much. Bloomberg's Ven Ram from the Bloomberg Markets Live team. And if you want more market analysis, check out Markets Live Go, MLIV Go on the terminal. As Ben said, he's been writing about valuations on US stocks. There's a lot in there on US CPI as well as we wait for that data. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In China, exports grew at a faster pace in June than the previous months. Exports in yuan rose about 21% from a year ago as COVID outbreaks and lockdowns eased. Still, the Chinese Customs Authority says the outlook for the second half of the year remains uncertain. In the UK, Rishi Sunak heads a final list of 8 candidates seeking to become the next Conservative Party leader and Prime Minister. Sunak's resignation last week helped trigger Boris Johnson's downfall. Today will be the first round of balloting among Tory MPs. The candidate with the least support is knocked out, along with anyone receiving fewer than 30 votes. Bloomberg has learned that the new U.S. owners of London's Chelsea Football Club have run into a potential tax liability. It has to do with luxury cars the team gave its players in recent years when it was owned by Russian businessman Roman Abramovich. Bidders for Chelsea learned about the issue during the sale process. They were told British tax authorities are investigating. And a big change at UBS. The Swiss bank has named Iqbal Khan to be the sole head of its global wealth management unit. That potentially sets him up as an eventual successor to CEO Ralph Hammers. Khan is currently co-president of the wealth unit. The other co-president, Tom Naratil, will leave UBS after 39 years. That a story that was making a lot of headlines in the banking world yesterday, Anna.
Yeah, absolutely. Coming up, we'll get back to the broad markets. We'll preview that US CPI decision. What should we watch for in the detail? What will matter to markets? Sandra Horsfield joins us, Investec senior economist. We'll look ahead to US CPI. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Inflation in the U.S. probably set a new 4-decade high last month. According to a Bloomberg survey, the Consumer Price Index probably rose 8.8% from a year earlier. That will keep the Fed on track for another big rate hike. It's all about oil. President Biden is on his way to the Middle East, where he'll try to persuade Saudi Arabia to boost crude output. His first stop will be in Israel. And Twitter takes Elon Musk to court over his scrapped $44 billion buyout. The company accuses the world's richest person of having buyer's remorse. Meanwhile, Google is putting the brakes on hiring. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons over in New York. European equity markets then, Matt, caught negatively today. US stocks sort of pausing for breath, I suppose. Modest gains in futures, waiting for that probably maybe, or whatever it was I just said about US CPI. Probably it'll be 8.8%, I think is the forecast.
Yeah, it likely probably rose to that level. And if so, you got to wonder how investors are going to react, because when we got the 8.6% reading at the beginning of June, markets collapsed. The S&P futures right now up about 0.3%. We still have to wait just about 2 hours and 59 minutes until that number comes out. So watch for the CPI. Obviously, surveillance is going to be all over it. The 10-year yield coming down right now to 295.95. It's not a big move, but investors may be preparing for that release. And NYMEX crude is up 94 cents, but that's after the big drop we saw yesterday. Oil was down like 7% yesterday on recession concerns, and especially if we get a higher print in inflation, the Fed's really going to be focused on fighting that rather than worrying about a recession. Bitcoin right now at 19,851, so up a little bit from midnight. The interesting thing, as I was saying earlier, is the last time we got an inflation print, June 10th, I believe it was, Bitcoin was trading around 30,000, and it fell to 20 within 4 trading sessions, so dropping by a third. If it falls another, well, $10,000 increments are what we have been seeing. So if we get a big inflation print, you could see it pushing down to 10 before it goes to 30. Kaylee, what do you see in terms of pre-market movers?
Well, of course, Matt, that would be in line with what our MLive Pulse survey respondents said. About 60% of them said it was more likely it'll go to 10K in the near term than 30K. So that's something to consider. As far as the action in pre-market trading, of course, we continue to monitor the saga still playing out between Twitter and Elon Musk. Twitter officially filing suit yesterday. No surprise, trying to force Musk to see through that $44 billion deal to buy the company. Twitter shares are up about 1%. And of course, elsewhere in tech, we've been keeping an eye on the Alphabet story, specifically Google, which is slowing its pace of hiring for the rest of this year due to the economic headwinds that it says it is not immune to, that all companies are facing. Still, that stock higher by about 0.2%. Another story to watch is Novavax. Politico reporting yesterday that the FDA could grant emergency use authorization to its COVID-19 vaccine as soon as today. So that stock is higher by nearly 2%, as is Delta Airlines. It will be reporting before the bell today, so just a couple of hours from now, but it actually rose 6% yesterday after positive guidance out of American, that kind of lifting sentiment for the airline industry overall. So we'll have to see what those results actually look like, but that stock up about 1.8% before the bell, Anna.
Kaylee, let's have a look at the European situation then. The picture looking pretty negative here, but really it's a little bit of a backward-looking story, reflecting some negativity on Wall Street yesterday. So European stocks making moves lower. In fact, most sectors in negative territory. We have 4 sectors moving higher. Real estate is the best performing sector here in Europe today, but that's up by 0.9%. Autos and auto parts, the worst performing sector. That weighs on the German market. Let me take you through a few of the currencies in focus today. We've got the pound, of course, in focus because we've got GDP data earlier earlier on from the UK, which actually looked pretty good on first glance. A few difficulties in interpreting it because of the movement of a public holiday we should keep in mind. And of course, euro-dollar in focus because we spent a lot of time yesterday on parity watch. We didn't manage to make it to that parity party, but we will certainly keep that under review and certainly keep that in focus as we look ahead to the US CPI data a little bit later on. What will that do to the US dollar and indeed other currencies beyond? With that in mind, let's move on our conversation and talk to Sandra Horsfield, Investec senior economist, who joins us here on set in London. Sandra, very nice to speak to you this morning. And let me get straight to that US CPI print. What is at stake for you then when it comes to this CPI number that we're expecting to see today?
I think the main focus will have to be not just what headline inflation does. We know the energy impact will be large and visible, but what happens to core inflation? That is really the crux of the issue. The Fed is keeping a very close eye on this. It's the core price pressures that they can affect through their monetary policy, and therefore that will be the main focus of the market.
Yeah, I mean, often we say, 1 month's worth of data, maybe we don't get too excited about what that means, but we saw this time last month, the CPI print had a real ability to influence the Fed's thinking. It led to a whole lot of Fed communication and a resetting of market expectations and delivered a 75 basis point jumbo hike. Do we expect this to be quite so market moving?
In our view, for the time being, price pressures are still very strong. We haven't quite seen the sort of effect that is large enough to bring about a big cooling in the US economy. We think it's coming, but not quite yet. So further actions on the brakes is likely to be necessary. Just how much? Well, the CPI prints and others are key to watch.
Okay. So you don't think that the US economy is currently in a recession?
For the time being, we're not quite there yet. We're heading in that direction. There's some signs of cooling. Certainly, if you look at the housing market in particular, the rate rises that we're seeing are starting to make a difference, and we expect that to continue. But overall, rising rates are designed to and will deliver a slower economy. We think some recession is inevitable.
And I mean, GDP contractions in Q1 and Q2, does that not concern you?
Well, as I said, some of it is deliberate because it requires some slowing in demand to bring us back in line with supply to affect the price balance that we're seeing. And that's what's necessary. We have inflation far above target, and these inflation expectations are starting to rise and will have to be brought back under control. Some recession perhaps is the price to pay to achieve that.
And what level of unemployment would that take, Sandra?
It's very difficult to say. I think we have to bear in mind we're starting from an incredibly tight labor market historically. So we've come out of COVID in a remarkably good position. And that's, of course, a welcome sign. But it does mean that the risk of second round effects in wages are that much greater. And so how hard do you have to step on the brakes? It's very hard to tell and very hard to calibrate ex ante. I think it's a matter of watching how the economy responds and then being able to let down and probably reverse some of the tightening that we're going to be seeing now.
Do you think that reverse comes in 2023?
Most likely, yes, it will be 2023 by the time we get there. Unlikely to be as soon as this year. But of course, much depends on, as I said, just how quickly we get that overall broad response stretching beyond that of the housing market.
Sandra, we got some data out from the UK a little bit earlier on, GDP. It was just for 1 month, and it's a little bit difficult to compare this year with last because of the movement of a public holiday. But the data looked much higher than the market had anticipated, growth of 0.5% in the month versus expectations of some contraction. Did that materially change your view, or are you focused on the downside risks?
It's very hard to be disappointed by a number that was so strong and so broad-based as well. We have not just a high headline print, but manufacturing was strong, construction was strong. All of this is a positive sign. And even the consumer sector only contracted very slightly, which is quite remarkable in the context of the cost of living crisis. That's likely to add to the pressure for the Bank of England to be forceful, as they had indicated beforehand. So the risks of more aggressive tightening in the near term, perhaps reversal later, are growing.
And for broader Europe, Sandra, finally, how much is the trajectory of the European economy, even the euro, as we talk about parity, going to be influenced by ECB policy when there's a threat of a shutoff of Russian gas?
This is clearly the #1 risk facing the economy in Europe at the moment, and one that policymakers are very much aware of. It is, again, the same situation in the sense that we're dealing with a very tight labor market. How much compensation will consumers demand for the very high cost pressures that are coming? How much will the government be able to offset? All of this will play into it. It's not just the fact that activity will slow down, but the wage response and how much policy action from the ECB is required as well that will play a part.
Sandra, thanks very much. Sandra Horsfield of Investec. We'll keep focused on that gas story that Kayleigh mentioned. Of course, UBS putting out some really interesting research talking about stocks dropping 20% and the euro going to 90 US cents if we saw those taps remaining closed. Now, coming up on the program, we will talk to Gary Shilling, president of A. Gary Shilling & Co. and the author of The Age of Deleveraging. He has some, well, some gloomy thoughts. We will try and find out if they are all gloomy thoughts about risk assets. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kayleigh Lyons in New York and Anna Edwards in London. Now, more on today's main event. The U.S. inflation print is due out at 8:30, so just about 2 hours and 48 minutes from now. Joining us to talk about that and the implications is Gary Shilling, president of A. Gary Shilling. He's also a Bloomberg opinion columnist and the author of The Age of Deleveraging. One of the big bears that we've been talking to for many years about, well, I was telling the ladies earlier that you've called 30 of the last 10 recessions. Is that fair to say?
Oh, come on now.
Gary, do you think that we're in a recession now? And I know that we have to wait for the official declaration by the NBER. That could take, you know, months and months, even a year after a recession before they officially call it. But it looks like we've had two back-to-back quarters of contraction.
Well, yeah, that's kind of shorthand. But if you look at stocks are down, you look at the yield curve is inverted, you look at confidence, consumer confidence is down, you look at the small business, you look at all these indicators, and I think it tells you we're in a recession, and obviously it depends on how you define it. But I define it as a contraction of business, and stocks are one of the best leading indicators of that.
And the S&P 500 is down 20% year to date. We heard from Michael Burry that was just valuation contraction, and now this earnings season we're going to see the margin contraction. How much further do you think we could fall?
I think we're about halfway there.
Halfway?
Yeah, I think we're about halfway, and I think for those reasons, you've knocked the fluff off, and now you get to the guts with earning contractions. And bear in mind that we've been floating really since 2008 on a sea of Federal Reserve money, and it's created a lot of speculation out there. You look at Bitcoin, you look at GameStop, you look at all these things that have collapsed once you take this away. Growth stocks, when you get high interest rates, their present value is worth less. A lot of things are really reflecting the idea that you simply do not have all that money from the Fed, and of course, all the fiscal stimulus money that came in reaction to COVID.
Okay, so if you think we're only halfway there when it comes to the stock sell-off, you probably don't want to be a buyer of stocks right now. What can you buy?
Well, you can buy Treasury bonds, which we're long. You can
Even though the Fed is hiking aggressively.
Pardon me?
Even though the Fed is hiking aggressively, now is the time to buy Treasuries.
because what happens is the Fed normally switches to ease once they've seen they've done the recessionary deed, and markets even anticipate that. And I think the Treasuries are beginning to see that. And of course, you get the fear aspect. It isn't just what the Fed does. And if you look at the 10-year, it's already estimating a 4.5% Fed funds rate if you look at the normal relationship. So I think you really had Treasury notes, and I'm a devotee of the 30-year bond, as you may know, because that's where you get the bang per buck when rates go down. Of course, it happens to reverse when they go up. But I think you're already seeing that switch. We're also long the dollar. We're short copper. I think commodities are in trouble. And I like copper on the short side because there's no cartel on either the demand or supply side. It isn't like oil where you worry about OPEC and Russia, and it goes into almost anything manufactured. So those are sort of the things that I'm interested in, and we're short stocks. We're short the S&P.
And you mentioned the pricing of the Fed terminal rate that's in the market right now. Do you realistically think the Fed can get there, given the kind of economic environment you're describing, the slowdown we're already seeing?
Well, these guys have a credibility problem. They were behind the curve. They were very slow in coming to the party. And they're among all other central banks. These guys move talk about cartels. These guys move together. And yeah, I think so. They got the bit in their mouth, and they really are worried about their credibility. And they're out to slay the inflationary dragon. We like to think otherwise, but they don't have paramount concern with what happens to the stock market.
Gary, good morning from London. You talk about being, well, you like the dollar. You're buying the dollar right now. How long does that dollar strength last? If we're halfway there on stocks, how far through the dollar move are we?
Well, I think the dollar has a long way to go. If you look at where you were back in 1985, for example, we're still well below that. And, the dollar is a safe haven. Also, Treasury yields are higher than they are in almost any other developed country's sovereign, so investors pick up a yield spread and also a translation gain when they move into treasuries. And you got to be in the dollar to get there. So I think the dollar has got a long way to go.
At the same time, we saw the euro almost touch parity yesterday, just fractions away, and the pound was down to 118. I heard a British former advisor to Her Majesty's Treasury yesterday, Ed Price, tell us he thinks maybe not now, but longer term, we could see the pound go to parity. Is dollar strength going to be that serious, or pound and euro weakness?
Yeah, well, it's a combination of both, of course. There are two sides of any currency trade. But bear in mind that the euro was well below par when it started in 1999 and early 2000s. So
I bought a car with the euro at 88 cents, I will point out.
Okay, all right, living example, man, living example. So I don't see any reason why I can't. I mean, currencies, there's a lot of implications, and it isn't just the markets that we live in. It's a whole of commerce that's involved with this. But I don't see any reason why you couldn't go back. Certainly well below par on the dollar and the euro. Again, the euro has virtually collapsed.
Yeah.
Gary, thanks so much. Thank you very much for joining us. Gary Schilling of Gary Schilling & Co. getting up super early for us in New York. We appreciate it. Coming up on Balance of Power, we will discuss the U.S. inflation numbers with White House Council of Economic Advisors, Cecilia Rouse. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance, who will be breaking down the CPI data at 8:30 a.m. Tom, happy CPI Day. What is your single best chart for this Inflation Wednesday?
Well, it's maybe the chart of the year. It's on America, but it could be on the world, and it's about the separation of goods and services inflation. We've showed it many times. We get an update here on a good Inflation Wednesday. Services inflation always higher than goods inflation, even goods deflation from time to time. Over the years, up we go, and the yellow line is the goods inflation exploding higher. We all know this. I mean, you got the used Bentley, Kaylee, and you know what you paid for that. 8.8% is where we are now. Goods inflation rolling over. Will it roll over? But the real important point in that chart is how does services inflation roll over?
And roll over, it is, or at least we're seeing it already in goods. Gary Schilling just joined us here, and he says he's already making investment decisions based on the Fed turning back down. Are you hearing more of that, Tom, that people are starting to really place their bets that the Fed's going to be reducing?
I think a lot of of people are doing that, not everyone, but yes, I think that's out there, Matt. But the importance is Dr. Schilling is absolutely the definitive person in the world on deflationary and disinflationary trends. He's got the Blue Book out years ago. He gives me royalties. I've sold so many copies of it. But Schilling's book, Deflation, is the definitive Bible on this. The physicist from Amherst is just lights out on price change.
Tom, thanks so much. Tom Keene with his take on the inflation data still to come, and indeed some of the voices that we have heard from. And we'll continue to hear plenty of voices, of course, on the US CPI print as we get towards that data and beyond. I was interested, team, in what the Bloomberg economics team was saying. They were talking about how some of the forward-looking data, and this chimes with your point, Matt, some of the forward-looking data that they see already suggests that there are downward forces working on inflation, but they think the Fed stays the course and continues to hike into that, which does raise interesting questions about the psyche around inflation and how far through the process of getting that to be entrenched we are, which is something the Fed is really worried about.
Well, and this is what Gary was saying as well, that the Fed has a credibility issue, right? They can't, even if inflation comes in lower than the estimate today, they can't be seen as getting off the brakes too soon. And if they only do 25 or 50 basis points rather than 75, not my take, a lot of people have argued this to me, they'll be in trouble if we get a higher inflation print next time. So they have to do the most that they can in order to show that they're on the case. Kaylee, don't you hear that from people as well?
Yeah, that's definitely what you hear, that the bar for the Fed to blink is just that much higher, considering they're already behind the curve, and they want to make it clear that this is their priority. Labor market mandate aside, inflation is really what they want to tackle. And Anna, to your point about some of those forces coming in to push inflation down, we have to keep in mind we're talking about 8.8%. The Fed wants to be down at 2%. The question is, how long does it take to get there? Because even if we see a deceleration in price growth, prices are still going up at a rate that the Fed is not going to be comfortable with.
Yeah, and Kaylee, they say they want to be laser focused on inflation. And we remember what happened last time when we got the inflation print and what that did to the Fed's expectations. We need to be alert to that, I guess, given the extent to which the number beat last time and what that did to the Fed's communications. And suddenly we were hit with the jumbo hike.
Does everybody want to be laser focused? Is there any other kind of focus besides laser focused? That's everybody's laser focused, right?
It's just, you know, it's really to emphasize the focus. It's not just focus.
And by the way, I'm looking.
Effective shorthand.
We're sitting next to each other.
I'm sure Matt can think of at least 3 or 4 things.
I keep hoping for a wide shot. Anthony, do we have a wide shot? Is there a wide shot?
I'm always in the way.
I guess not.
I'm just in the way of your wide shot. That's the problem. Right, that is it for Early Edition. More surveillance is ahead. Tom, John, and Lisa will continue to be laser focused on the inflation print, which is due out in the US a little bit later this morning, of course. Global markets, no doubt, focused on this number. What will it do to euro dollar? There's one asset to watch. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is the bear market that won't end.
The time to move into a little bit more duration has come.
The thing that we have to try and do is to trade off this volatility that we see persistently in the equity market.
I'm not sure that we will see disruption from this slowdown in the economy.
The pace of disinflation over the next year, I think, is likely to be quite a lot quicker than markets expect.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is CPI Wednesday, live from New York City, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures positive 0.2%, 1%. TK the data, 2 hours and 30 minutes away.
Yeah, yesterday was Euro Parity Tuesday. I mean, you know, it's too much. I love what Kitchuk said in his note. Can we all get over the idea?
What did he say, Tom?
I can't remember the insanity of Euro Parity. Just, you know, enough. But actually, this is serious. This price change dynamic today, what's beneath the headline numbers, is going to be stunning, John. David Rosenberg saying, everybody calm down. We're going to see disinflation. And as you know, John, could we see double digit on the other side of that debate?
How sticky will it be, Tom, into year end? That's got to be the focus of the conversation.
Yes, I think the x-axis is the, yes. This is really important, John. It's not going to be about levels so much, the y-axis. It's about trying to determine the x-axis and the partition between goods and services. That goods inflation has to come down.
Lisa, headline CPI, the estimate at the moment in our survey, 8.8%. This market will be focused on the core month-over-month figure and going through all the compositional shifts we might see.
That's exactly where I wanted to go. Do you think that the market actually will be focused on that? Or do you think that if we get a 9%, 9.1% inflation rate for the headline CPI, that will rule the mood on markets more than anything that we see month over month in core CPI? I mean, it's an honest question, John, at a time where the Fed is saying we don't want to parse out too many nuances given how high inflation is relative to history.
So what's the market interested in? The market's interested in what the Fed might do in response to the economic data.
Correct.
We can agree on that.
Yes.
This Fed is far more sensitive to upside surprises than they will be downside surprises. They will need to see a string of softening CPI prints through the next several months to get them to back away anytime soon.
Especially since there's certain inputs that are expected to increase in terms of, for example, rent and rent pressure that is expected to actually add to CPI later in the year, even though you do expect to see some sort of easing from the pressure of gas prices. All of the nuances here leading people to say the core might not matter quite as much as it has traditionally as the full benchmark the Fed considers.
Should we throw in some corporate guidance as well? Interesting to hear from Google, who had this to say, Tom. They're planning to slow hiring plans for the remainder of the year. There was some commentary from the CEO, but I love this line. We need to show more hunger than we've shown on sunnier days, Tom.
Yeah, I think these notes are starting to come out. Joe Feldman over at Telsey Advisory Group with a smart sum on Amazon still outperform, but he knocks a price target on Amazon down from 170, I think, to 145 there, and it's just on a little bit of dampening of the consumer. So, John, we're going to see that. When is J.P. Morgan? Is it tomorrow?
J.P. Morgan tomorrow.
Tomorrow, okay. So we're going into that, but I would just suggest that the inflation data, it's really important, and all of a sudden, we're focusing 3 inflation reports out to September 21. That has my attention.
You mentioned Amazon. Let me pick up on Apple. We've seen a series of price target cuts there as well.
Yeah.
This from Jim Suva of Citi, Lisa, who had this to say: we've made changes to our estimates to reflect supply chain constraints, worsening consumer spending woes affecting broader device demand. Price target's still pretty punchy at 175. It's down from 200, so there's some serious upside there. But you're just starting to see those cuts come in ahead of earnings later this month.
The fact that the cuts are coming from the behemoths, the rock solids, the ones with fortress cash balance sheets, shows the concern out there of what the effect could be. The Google example, Google traditionally hasn't been affected by some of the consumer economic cycles as other companies. So the fact that they're coming out and paring back some of their hiring plans tells you a lot.
John, can I be optimistic, John?
Please be.
Goldman Sachs, lower recession probability in your United Kingdom. I'm sorry, the numbers really weren't all that bad.
They weren't that bad, but did you see what everyone started to price for the Bank of England, Tom?
Yeah,
they started to call for 50 basis
green light,
points.
up they go. I mean, I get it, but I'm just suggesting, as you started the show on, there's a stew of data out there, both optimistic and pessimistic, and we'll see.
Are you constructive on the single currency, on the euro?
Well, I don't know. I'm not going to go all of Mundell on you. I don't know about the euro. I'm still focused on EM, which I get is a sideshow. But the fact is, EM is unraveling.
I come in every single morning, Bramo, on the Bloomberg terminal on Tom's desk. It's just a chart of euro dollar. He's just waiting for that line in the sand. That's all he's focused on.
Line is in.
He doesn't even
It's like Dow 10,000.
I know he doesn't. Futures down, or up rather, by 0.2% on the S&P. On the Nasdaq, up by 1/3%. I'll give you a Dow quote, Tom. Go on.
Please. No, I just think it's just important here to understand the line in the sand. You sound like George Bush Sr. here. Come on, John. Let's be honest here. With the Dow up 59 points on futures, we got to understand that EUR parity. It's just like Dow 10,000.
Without a doubt, 10040. TK has the hat already made. We're unchanged on euro dollar going into this. Yields in a little bit, down a basis point, 295.58. The one thing we haven't discussed so far this morning, Bramo crude got absolutely hammered yesterday. WTI 96.59.
The difference between the people who are fundamentally analyzing supply and demand and the idea that, frankly, supply is not going to meet demand in the oil market, and then what you're seeing in the price action, that divergence is really notable considering the fact that oil has come in as much as it has. 8:30 a.m., we're all talking about it. The U.S. June CPI numbers come out. People will be talking about the headline figure, the estimate of 8.8%, Deutsche Bank saying 9% even, versus the core, which is expected to come in a little bit. I'm watching real wages. How much do we see an ongoing deterioration in the negative real wage experience of the average American? How much is this going to be what guides the outlook for the Federal Reserve and for policymakers in general? Because this is the dampening effect on growth from inflation, regardless of where it comes from and how it's going to really ease off. At 10 a.m., in terms of central bank responses to it, the Bank of Canada is meeting. They have been actually a bellwether in terms of what central banks are thinking. The expectation is for 75 basis points, bringing it to a 2.25% rate, overnight rate. However, some people are expecting a 100 basis point move, and this follows the Bank of Korea's record 50 basis point move overnight, and also the Reserve Bank of New Zealand's 75 basis point rate hike, or I believe 50 basis point rate hike, but there's a speculation that they could go further. How much is this really pushing the Fed toward being more aggressive no matter what? And at 2 p.m. we get the Fed Beige Book. This is also something that Tom watches very closely for the tea leaves of the American economy. I, however, want to know what the influence will be on gas, because we have seen gas prices roll over a little bit, giving a little bit of relief. How much is that really stemming from a lack of demand versus other issues, including perhaps a bit more in terms of the refineries and the activity there, John?
Bramo, thank you. Your day ahead with Lisa. Lisa, thank you very much. Steve Sosnick joining us now, Chief Strategist at Interactive Brokers. Steve, let's start here. CPI inflation data, a couple of hours away. What are you looking for?
Well, I'm not going to diverge too much from the consensus. I think we'll 8.9 seems like a good enough place for me to start. I think you were hitting on it earlier that the question will be, if the number is not what we expect, what will the reaction be? Will people freak if it's even a tenth above? They might, but because people are so on edge. Also, the other question becomes, when we get into the core, we're starting to see some of the food and energy prices, at least very, very short term. Yesterday, they rolled over a little bit. That's way too early to affect the numbers that we're going to see today. But how does that start to come out, and how does that start to impact people?
Steve, I love your note where you talk about that venting that's going on and the inflation rhetoric The reality is, a la American Airlines' view yesterday of, I believe it was 12% revenue growth, the inflation rhetoric folds over to a better than good revenue line for companies. Is that what we're missing as we look to the earnings season?
What I think for earnings season is which companies will be able to pass it along, which companies are just going to have to eat it in terms of lower margins. Right now we know the demand for travel is great, and so American Airlines has been a beneficiary of that. We'll hear from Delta in a little bit how they're benefiting. But there's so many other companies that are not going to be able to pass this along. Between that and that margin pressure and between stronger dollar on multinationals, there's going to be a lot of divergence during earnings season in terms of which companies can handle it and which companies are just going to have to report worse results or worse outlooks as we go forward.
Just quickly here, Steve, on CPI Wednesday, heading into JP Morgan Thursday, and then University of Michigan Friday, which is going to be the most important data point of the week?
It still has to be CPI. If I'm going to rank them, I'm going to say CPI, Michigan, and JP Morgan as a laggard third. I wrote something yesterday. I really wish we could rearrange earnings season. I don't love the banks as being the bellwether because they're so fluky and idiosyncratic. Yes. What does JP Morgan's trading numbers tell you about the rest of earnings season? Zero.
I hate the arc of earnings season too, Steve. I'm so pleased you said that. Steve Sotnick of Interactive Brokers.
How much did you pay him?
Nothing. We've never talked about it before. I hate it too.
And John, what's important here is they do it correctly in the United Kingdom. This is important, John. I remember when earnings season was the back page of the Wall Street Journal, 3 lines, revenue, operating income, net income, and you looked at the boxes and you had a felt thing in your hand and you circled the 5 or 6 that mattered, and then you looked up value line to try to get smarter before you read the street research. John, it came printed, not in PDF. And the fact is, John, England does this better than the media hysteria here venting about 4 or 5 big banks.
I had this conversation with Stuart Kaiser at UBS in the last couple of days, and I actually asked him, given the arc of earnings season, how are you going to trade this? Because you know what comes first, the banks do, then tech comes a little bit later, and further down the line is the retailers. And Lisa, we're trying to get a decent read on the consumer right now, and the retailers are an important part of that puzzle.
Yeah, but it depends on whether they're buying clothes or whether they're buying Pepsi products, evidently, as we heard yesterday from PepsiCo. The idea that demand there is really picking up and they're able to pass along, and then some of the inflationary pressures versus clothes that people have already bought a lot of, particularly the stay-at-home brands and companies that have already built up their inventories of yoga pants when people actually want real pants to go back to work.
Yes, we do want real pants.
That felt personal.
Yoga pants.
That really did.
John, she's
hey, watch it, John.
She must be planning another vacation. John, you and I can't remember. We were on our 3rd or 4th gin and tang, and I can't remember, but what matters to me, I want to know what Home Depot's doing.
Yeah, I'm with you. I think we should lead with the tech names, personally. Lead with the big weightings on the S&P. Let's get those earnings done.
That's far too...
Your vote has been submitted.
Thank you. Not that my voice on this counts for anything. Futures up 2/10. It is CPI Wednesday. TK's super excited. On a beautiful morning
when you say that, John.
In New York City.
Jesus.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Numbers out today will show that inflation in the US likely hit another 4-decade high last month, according to the median forecast. In a Bloomberg survey, the consumer price index probably rose 8.8% from a year ago. That would be the largest jump since 1981, and it would keep the Federal Reserve on track for another big interest rate hike this month. The CPI is out 8:30 a.m. New York time. President Biden's problems at home are looming over a Middle East trip that's all about oil. The president arrives today in Israel, the first stop on his journey. It's the visit to Saudi Arabia that's seen as crucial. The hope is that restoring relations with Crown Prince Mohammed bin Salman will secure a boost in oil production and help ease gasoline prices, but a deal is far from a given. And in the UK, Rishi Sunak heads a final list of 8 candidates seeking to become the next Conservative Party leader and Prime Minister. Sunak's resignation last week helped trigger Boris Johnson's downfall. Today will be the first round of balloting amongst Tory MPs. The candidate with the least support is knocked out, along with anyone receiving fewer than 30 votes. Twitter has now sued Elon Musk over his abandoned $44 billion takeover bid. In a suit filed in Delaware, lawyers accused the world's richest man of having buyer's remorse after his fortune declined. Musk scrapped the deal over concerns about fake accounts. Google plans to slow hiring for the rest of the year. In an email to staff, Alphabet CEO Sundar Pichai noted the possibility of a recession and urged the company to be more entrepreneurial and work with greater urgency. He said Google will focus on hiring engineering, technical, and other critical roles. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells. No one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. Season is here.
It's a low bar going into earnings season.
There are bargains out there to be had.
Bloomberg is fastest with the numbers and analysis.
There's conflicting and complex cross currents. Strap yourself in for this earnings season.
Bloomberg, the fastest numbers and analysis you trust.
We're engaged in a very challenging exercise.
which is to try to cool the economy down to normal levels, right, in an effort to bring inflation under control, but without the intent of trying to cool it so down that the decline is calamitous. The right policy is to get inflation under control, period.
Threading the needle. Thomas Barkin there, the Richmond Fed president of the Rotary Club of Charlotte. From New York City this morning, good morning. Tom Keene, Lisa Bramett and Jonathan Ferro. Futures positive 0.2% on the S&P 500. On the NASDAQ, up 1/3%. It's CPI Wednesday. TK, so excited. Yields lower by a basis point, 295.39.
It's CPI Wednesday. Tomorrow is Carlos Rodon Thursday. He's up against the Brewers, the great pitcher of the San Francisco Giants. John, this is a throwback. I'm sure there's somebody in English football like this. This guy is from another time and place. He picks up the pebble and throws it at home plate as hard as he can.
Is Carlos excited about you, Mitch, Friday?
No, he didn't go to Michigan. He's not that kind of guy.
You're just trying to watch him up. And it's
John, are you aware on the commercial break, Brammo's writing an auction newsletter?
I'm very aware of it. I just received it.
It's ridiculous.
Sending it out to Bloomberg clients.
Well, someone asked me. They said, why didn't you mention the 30-year auction?
Okay, here's your moment. Quickly, you've got 20 seconds before we get to AMH. Go on.
Okay, so someone said, why didn't you talk about at 1 p.m. today you get a 30-year auction of treasuries? And I always talk about them, and Tom always denigrates them and says he's asleep. And I didn't mention it because the other things going on and because I didn't want to repeat that conversation. But it is really interesting because the 10-year auction yesterday went worse than expected at a time when people are piling into duration as the conviction trade right now. So does this indicate that this perhaps doesn't have as much real money behind it as it does trading activity in a pretty illiquid market right now relative to history, because you have seen trading volumes come down a lot? That was my 20-second brief.
Totally agree. Can someone wake up Tom? Anyone on the studio floor in there? TK, you still with us?
Yeah, I've had the morning tang. I'm ready to go. I'm excited about CPI Wednesday right now. Joining us from Jerusalem, she is just down the street from the pink limestone of the King David Hotel. Anne-Marie Horton joins us. Anne-Marie, the president is en route. What is his #1 goal as he visits Israel on this historic trip?
Well, Israel is really a stopover to what his #1 goal is, which is going to be in the Kingdom of Saudi Arabia. And that's, of course, to meet with Gulf leaders, especially the Saudis and the UAE are the two countries that have this spare capacity for oil to help him at home. But, of course, here in Israel, he is going to want to make sure that he is discussing with leaders. It's going to be, though, an interesting meeting because the Israelis right now don't have a government. It recently collapsed. They're looking forward to elections in November. So he'll be in the hands of a caretaker prime minister, Yair Lapid. But really, it's about getting the Israelis to normalize with more Arab countries, to really expand upon the Abraham Accords that happened during the Trump administration. And this is a place that he can stop and begin those conversations. And then when he goes to Saudi, he'll be the first U.S. president to actually fly directly from Israel to Saudi Arabia. Potentially, this could be foreshadowing something that could happen in Saudi Arabia, which is more Israeli flights being able to use Saudi airspace.
But, Anne-Marie, this is not James Earl Carter and Anwar Sadat. There's some real nuances here as well. Subdivide. Give us a little clinic on the response of the different Arab nations and tribes to Israel. Who is most amenable to Israel?
Well, it's those countries that normalized. It's Bahrain. It's United Arab Emirates. I would say the UAE particularly. You're seeing direct flights from Tel Aviv to Dubai. There's a ton of talk of it. Even just everyday people talking about the fact that they can now go to the Emirates, and likewise Emiratis being able to come here in Israel. And there's huge business opportunities between these two countries. But the biggest economy, of course, in the Gulf and in the Middle East is Saudi Arabia, and that leader of the GCC. And this would be the country that especially the Biden administration would love to see this normalization of ties. But Saudi Arabia has made this policy very emphatically saying that they will not normalize with Israel officially until there is a two-state solution. But you do see a lot more cooperation between these two countries, and a lot of that has to do with the fact that they have one serious common enemy, and that is Iran.
Well, meanwhile, I'm wondering how amenable the Middle East is going to be to responding to the U.S. demand for more oil and more playing ball with them in terms of isolating Russia. And I say this as there was a little observed article talking about how flows from Russia to the Middle East have been increasing of crude steadily throughout the year, a sort of untraditional relationship where the Middle East is trying to capitalize on the cheaper prices from Russia and the step back from Europe and the United States. How much clout does the U.S. really have to affect the Middle East and their approach to oil?
Well, we should first by saying that the Middle East at the moment doesn't have a ton of spare capacity. It is two countries we are talking about, the Kingdom of Saudi Arabia and the United Arab Emirates. And together, it's a little bit under 3 million barrels a day. Yes, there's that report that there are Russian oil coming into the Middle East. Very hard to track the exact barrels and where they're going. That Russian oil getting mixed in with some of the Middle East crude. Where does those products go? Very hard to track exactly. But that does seem to potentially be easing some of the pressure on the Middle East and maybe the kingdom and the Emirates, which can acquiesce the president's call. But this is only one part of Biden's problem when it comes to the energy market. The other is, of course, spare capacity, refining capacity, and the spare capacity for that is in China. So this could potentially help him a little bit at home. We saw OPEC Plus nations give a nod to that at the last meeting. Everyone thinks they could potentially backfill some of these countries that are not meeting their quotas, like Angola or Nigeria. But it's not as though this trip to the kingdom is going to solve his gasoline problem before the November elections.
Anne-Marie, brilliant. Looking forward to the coverage through the week. Anne-Marie Hordern there. Over in Israel, TK, to Lisa's point, as we build out this trip through the week, we head towards Saudi Arabia, and gas is going to be a massive focus for a lot of people in this market. Gasoline prices have been coming in, but maybe a little bit too late to affect today's CPI print, Tom. But going forward from here, can we start to see some of that, hopefully, fade out, fade away?
Yes, you can see it on the Bloomberg screen, and I would use copper as a major proxy for this. It's not just about hydrocarbons, but yes, politically for President Biden, it is front and center about a gallon of gas, and everybody I'm talking to, the Bentley's in the garage, I've got a driver in, and John, I'm sorry, it's come in, 10, 12, 15 days in a row.
40% of core CPI. Let's talk about that. Lisa, you've been on top of it every single month. It's rents. And rents could be the component that maybe we're surprised by again. And that's the worry that hangs around. That lives beyond the crude gas story and sticks with us through year end. And that's going to keep the Fed on course to hike more.
There are predictions that the rents are going to reaccelerate. Rent inflation is going to reaccelerate heading into the fall, offsetting some of the decline that we've seen in gas prices. That's one worry. The other worry is that people are still spending. And this really speaks to the idea that perhaps gas prices are rolling over. But is demand really rolling over, or is it other issues? And that, I think, is really a key point.
Deutsche Bank came out early with a recession call for next year. They've had to bring that in. Peter Hooper at Deutsche Bank is going to be joining us very shortly. Futures up 0.2% on the S&P. Inflation data in America. You said it. 2 hours away. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?